workable path either. So it's clear there's some potential here for a broad negotiated kind of a settlement. The open question is whether we have the right leaders for the job now and in the future.
Jared, just before you go, you did make this point. I do want to dig a little bit further where you said if you could see one data point to set asset allocation into 2030, it would be the level of the U.S. dollar. Can you give us a sense of how the asset allocation would change if it were strong or if it were weak?
Let's say just DXY getting down to 90 or even to 80, a great global rebalancing in goods and capital. I think that unlocks potential across the market. So deep value, arguably value traps in the market today, places like European and Chinese equities, could suddenly become live options again for investors. Tech sectors, growth stocks, suddenly become much less attractive compared to value. Real assets can perform really well. Alternatively, if there is no real policy leadership on the global stage or there isn't a path to some kind of success and you just see continued excessive dollar strength, let's think about DXY at 120, then the thesis there is just there simply is no alternative to the U.S. market, and the dominance of growth stocks, of tech and treasuries and so on from recent decades would be expected to continue. The danger there, of course, is that's how most investors are already allocated today. That's where the length is in positioning. I think that could set up some really unpleasant overvaluation, even bubble-like conditions that can create a lot of fragility and even volatility in the market at a generational level. I think it's an extremely important policy moment, and given how extreme positioning valuation is becoming, markets are really exposed to what happens in these big picture policy debates in the years to come. It's extremely important.
Jared Woodard, we look forward to speaking to you sooner than that to talk through what some of these policy implications are. Jared Woodard of Bank of America, we really appreciate your time and happy holidays. Right now, let's get you an update on what's going on in France and other stories. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. French President Emmanuel Macron has named Francois Bayrou to be France's new prime minister. The pick is the long-standing centrist ally. Bayrou will take over for Michel Barnier, who resigned last week after far-right and leftist coalitions united to topple the government. The incoming prime minister will look to avoid a government shutdown and pick up the pieces of a 2025 budget plan. Meanwhile, President-elect Donald Trump met with leaders of the International Longshoremen's Association yesterday. In a social media post, Trump expressed his support for the union and criticized automation, saying, quote, "The amount of money saved is nowhere near the distress, hurt, and harm it causes for American workers." Union members, which walked off the job earlier this year, may strike again in January. And the FBI and the Department of Homeland Security say they continue to investigate reports of mysterious drones flying over New Jersey. They've been reported hovering over critical infrastructure, including water reservoirs, electric transmission lines, as well as police departments and military installations. But yesterday, the White House downplayed concerns, saying they appear to be legally operated aircrafts and that the FBI and DHS have yet to corroborate the sightings. That's your Bloomberg Brief. Lisa?
Weird drones. Thank you so much, Yahira. I've got to say, a little concerning. Wouldn't really want to see what's operating.
And not far from where we're sitting right now. This is New Jersey, so what I call the upper west side. But Admiral Kirby says the White House, nor state, local law enforcement, none of them are able to corroborate this.
No more conspiracy theories, please. Like another thing that people are like, oh, now aliens at the end of 2020. We just don't need it.
I wasn't thinking that. I was thinking more some sort of foreign actor that was hovering over, but let's go to aliens. Let's actually not. Up next, a new tariff warning.
He wants to use tariffs as a major cudgel in bringing people to the negotiating table. I think that would be a real ticket to bring foreign direct investment coming into the United States.
That's coming up next. This is Bloomberg Surveillance.
there is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
Really? Is that where people's minds go? I'm just curious. Is that really
it's been a weird year. Why not aliens?
Okay, all right. Well, let's, okay. Meanwhile, people are looking at something other than tariffs, other than aliens, tariffs, and they're looking at markets that haven't really been responding as much to them, trying to bounce after a week of losses. But it's been a strange year, and there has been this real elevation of valuations, getting people nervous, as well as aliens. Under surveillance this morning, a new tariff warning.
My ability to be ready day one to implement President Trump and House Republicans' financial services priorities and regulatory rollback. He wants to use tariffs as a major cudgel in bringing people to the negotiating table. I think that would be a real ticket to bring FDI, that the president talked about yesterday, foreign direct investment, coming into the United States.
Here's the latest. Donald Trump's proposed tariffs leading officials in Canada to weigh export taxes on key commodities shipped into the U.S. Sources saying the move is seen as the last resort by the Canadian government, with taxes set to drive up costs for U.S. consumers, farmers, and businesses. Joining us now is Bloomberg's Mike Shepard. Mike, great to see you. Thank you so much for being with us. I want to just start there. How much have we heard some rumblings of what the tit for tat and the retaliatory tariffs would look like from some of the other countries that the U.S. might be going after?
They haven't gotten to nearly as much detail as what we've heard from Canada already. Earlier this week, in fact, we heard Canadian Prime Minister Justin Trudeau address a business group there in Halifax, warning that retaliatory tariffs, the initial response to any imposed by the U.S., would be immediately on the table. And now we're getting a sense that they would go a few steps further, and that includes export controls and taxes on exports. And this would hit key products coming into the U.S. We're talking about oil, we're talking about uranium, we're talking about potash. These are all real critical inputs. The U.S. imports 4 million barrels of oil per day from Canada, and that would have an immediate effect, especially in the Midwest, in mountain states where a lot of that fuel is refined and sold. Likewise with potash, it's a key input for fertilizer used by farmers across the country. So that would have a big effect. It would not be great for Canada either, and Trudeau's own compatriots are not all aboard with that. Some politicians in Western Canadian provinces are cool to the idea of certainly of Trump imposing tariffs on Canadian goods, but the response, including export taxes, would be much more severe. We do, to your question, Lisa, though, in conversations with officials from other countries, we are not getting to that granular level of detail. They're much more in wait-and-see mode. And while they, as Congressman Hill alluded, see it as sort of an opening shot in negotiations, they don't want to show their cards too early, it would seem.
But sounds like potentially, if Canada were to lean into this idea and to do this, that the Trump administration would probably offer carve-outs for commodities, would they not?
Well, that is what a lot of observers are saying, Anne-Marie, and that's a great question, because one of the ways that they could minimize the impact on U.S. consumers and businesses would be to exempt oil and concentrate instead on more finished goods like automobiles and auto parts and things of that nature. But again, it is early, and if they really wanted to have an impact and send a message to Canada about what Trump wants, remember, this is not really about economics. This is about the border. Trump is using the threat of tariffs to try to extract policy concessions when it comes to border enforcement. He's waving this threat against Canada, and even more so against Mexico Mexico, where he's concerned that the flow of undocumented migrants and fentanyl into this country is causing problems here. And he wants our neighbors to do more, and he's using tariffs to try to get them to do that.
Well, Justin Trudeau is planning a major announcement on border security because of that. So is Trump's negotiating tools working?
Well, maybe in a way, and it's that is certainly one way to put it and look at it, that he has gotten both those countries' attention. In fact, the new Mexican president, Claudia Sheinbaum, has also tried to make some steps of her own. She has reached out also to Donald Trump, just as Justin Trudeau has. You'll remember Trudeau even flew to Mar-a-Lago for a one-on-one dinner, a dinner with Donald Trump, and spend some time with him also on the phone. She has also called Trump and tried to take some steps that she can follow through on when it comes to the border and drug enforcement there. But Trump will be asking for more. And remember, when it comes to the negotiation, as Congressman Hill alluded to, the USMCA deal between the U.S., Canada, and Mexico that Trump forged during his first term, that is up for review in 2026. So this is also a warning shot ahead of that conversation with the two neighbors.
Shep, just big picture here. Is it really that unusual that Canada has a game plan for worst case scenarios? Can we not expect that most countries confronted with tariffs coming from the U.S., that everybody has some sort of idea of what they might do in a tit-for-tat trade war?
Well, in conversations recently with other major officials from other major U.S. trading partners, one thing that struck me was the detailed level of knowledge they had about their trade flows, including with the U.S. So, yes, they have a pretty good idea of where to hit the U.S. and how to make it hurt. And in fact, you know, when you look at U.S. trade, the last time that we got into it with tariffs in Canada, they went right after things that were distinctly American: Harley-Davidson motorcycles, Kentucky bourbon, Heinz ketchup. So these are the kinds of things that send a message, not only economically, but politically as well, and get the U.S. government and administration's attention.
Mike Shepard, always wonderful to hear from you. Thank you so much for being with us. Bloomberg's Michael Shepard there. We did get an update on what happened with that vote with French Hill on the Hill. Anne-Marie, what's the latest?
He got the endorsement from the steering committee, so he is ready to go in terms of getting the gavel when it comes to the very powerful House Financial Services Committee. And if you read a lot of the reporting about what went on behind closed doors, it really was a fight between 3 or 4 individuals, and he was able to get it on the second round.
At a point when he would be the first, I believe, chair of the House Financial Services Committee in quite a while who actually has run a bank.
He's run a bank, yeah, that's right. He's also the individual that's been the most outspoken about regulation and when it comes to the crypto industry, really warming to the crypto industry. So those individuals, I'm sure, are very happy to see him get that chair.
Well, it'll be interesting to talk with him going forward about what some of his plans are. Coming up, we'll be talking about some of the increased activity that is expected in the banking sphere. Jason Thomas of Carlyle on the M&A outlook for 2025 at a time. Some people have argued maybe this has to do with rate cuts, maybe not. We'll discuss. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Ending the week with a positive note after what could be the first week of losses in about a month. We are 2 hours away from the cash open. Let's get to your morning movers with Manus Krania. Good morning, Manus.
Lisa, good morning to you. When your AI sales rocking up by 65%, that's a powerful signal for Broadcom. When you tell the market the addressable market is going to be 60 to 90 billion by 2027, that's when you begin to grasp the magnitude of what AI chip delivery is all about. The rest of their business, not as powerful. The semiconductor size of their business, the regular semiconductors, up 10%. These guys have got an EBITDA margin of 66%, and they've hiked the dividend by 11%. What's not to love about Broadcom this morning? PayPal, roll it over. Well, if you're not part of the PayPal mafia in the Trump cabinet, there's always, you can look back at the stock. Wolf upgrades the stock to outperform, potential upside $107. This is the largest digital wallet outside China. 220 million active users on this wallet. So it is about monetizing and squeezing that. Now, RH, or Restoration Hardware, as I used to know, but anyway, letter from the CEO. This is the worst housing market in decades, and yet they squeeze out a 24% uplift in demand in November, a 30% uplift in demand so far in this month. This is the personification of the wealth effect in the United States of America. They're raising the guidance. This is a gutsy call. We're not going to be impacted by tariffs coming from China. So that's what they're saying to the market, and also get ready for a pretty spectacular curtain raiser. I can tell you this, I don't think I'm their typical customer. You walk into that store and it's, are you ready to buy the whole room, sir? Not the sofa.
Manus, thank you. And we look forward to your next review of Restoration Hardware. Under surveillance this morning, the Wall Street Journal reporting that President-elect Trump's transition team is looking at ways to shrink or consolidate bank regulators, including potentially abolishing the FDIC. AMH, how feasible is this?
So it's not feasible unless you get Congress on board. What I find very interesting is that you have a bunch of some of these officials, they're trying to find ways, and part of the Trump transition team alongside Doge, trying to find ways where they can cut some of the fat in spending, and asking whether Trump could abolish the FDIC, which gives you pause because, one, not only do you need congressional support, but the banking world is just giddy about Trump world coming in and easing regulations. But what happens if you were to get rid of the FDIC? It's considered sacrosanct. Could you actually see even maybe a run on banks? So this may be a bridge too far, and not sure Congress would go along with it.
It does make for some headlines that get the euphoria to continue. Meanwhile, Amazon donating $1 million to Trump's inaugural fund after, of course, we heard from Meta. A spokesperson saying they'll also live stream the inauguration as an in-kind donation. Bezos is set to meet with Trump next week. He has a range of business interests that hold federal contracts. And of course, everyone is eyeing Elon Musk, Danny, and saying, can I be your first buddy? Maybe just second buddy.
Can my stock also be up 70% since the election? That'd be nice. As Ed Mills from Raymond James put it yesterday, this is getting a seat at the table. And I think it's also interesting, as you lay out, that Bezos isn't just giving the money via Amazon. he's going to be meeting with Trump. And we know Trump often listens to the person who was last in the room with him. It's not just Bezos. Sundar Pichai, who apparently was at Mar-a-Lago on Thursday, according to the information. Zuckerberg dined with Trump after the election win. These are people who are trying to get their ear. And for people like Amazon companies, it's important. I mean, we'll remember there was a lot of back and forth in the first Trump administration. He basically called the U.S. Post Service their delivery boy and launched an investigation into some of the prices they were doing. So Bezos and Amazon probably want to avoid that this time around.
We also are hearing some response from other countries, as we were talking about with Shep. Canada weighing the use of export taxes on the United States and commodities, including oil and uranium, as retaliation against Trump's expected tariffs. Sources telling us here at Bloomberg those export levies would be a last resort. Retaliatory tariffs on American goods are likely to come first. Anne-Marie, everyone's trying to position ahead of what could be a tumultuous 2025.
And you already see Trump almost renegotiating USMCA before 2026 with both these partners, Canada and Mexico. But when it comes to Canada and these commodities, Canada is by far the largest external supplier of oil into the United States. So if they were to go ahead of this, I mean the Trump transition team in terms of this massive walls going up with Canada, you have to think there's going to be massive carve-outs as well.
In the meantime, people lining up for the banking side of things. Let's turn to M&A. Investors expecting a bang-up 2025 thanks to President-elect Trump's policy proposals, as well as FTC pick Andrew Ferguson. Jason Thomas of Carlyle sharing those expectations, writing this: when coupled with the resolution of election-related uncertainty and prospective policy changes, the fall in finance costs should lead to a dramatic pickup in M&A activity in 2025. Jason Thomas of Carlyle joining us now from our DC studio. Jason, thank you so much for being with us. Happy holidays. We're rolling that out. I do want to get your take on the M&A boom that everyone is saying is going to be in 2025. How much is because of policy changes, and how much is because of an interest rate backdrop that looks potentially very different?
Well, it's hard to ascribe exact proportions, but I think the important thing about the rate outlook is that for the last 2 years, there's been very strong expectations among market participants that rates would be much lower in 12 months' time, in 18 months' time. And I think that led a lot of sales processes to be postponed. This idea, let's not sell today, let's wait for 12 months when rates will be 200 basis points lower. Prospective buyers will have a much easier time obtaining finance at cheaper rates. They'll be able to pay more for this asset. And so now I think we're finally at a point where there's much more symmetry in terms of the expectation for rates. Not only today do you have a Fed that certainly is going to cut next week, but how many more cuts are really coming? I think that there's some strong signals when you look at inflation that policy is currently a lot closer to neutral than it is restrictive. So, maybe 2 more cuts in 2025. But that could very easily be offset by significant spread widening over that period. If you look at credit spreads today, we're talking about the tightest levels since May of 2007. So I think that rather than the idea of postponing sales processes or postponing acquisitions for better financing costs in the future, there's a sense that acquirers, sellers need to act now while conditions are as favorable as they are.
Jason, this is fascinating. It speaks to not necessarily rates going lower or higher, but stability being the most important ingredient to understanding why someone would pull the trigger now versus wait a bit longer in order to have a transaction. If rates stabilize at this level, though, Jason, do some of the acquirees have to accept lower prices than when they were evaluated in pre-pandemic times, where the base understanding of rates was vastly lower?
Yeah, I think we're going to go through a very interesting period of price discovery. So first, though, I think it's worth noting, if you look at single B effective yields today, they're only 50 basis points above where they were in March of 2022 before the Fed first hiked rates. So this spread compression has been quite dramatic and has offset much of the increase in base rates. So I think that, again, just appreciating that the scale of spread compression is very important for these pricing discussions. Secondly, I do think most of the transaction volumes are going to involve more seasoned assets that were entered into in 2018, 2019, pre-pandemic. I also think it'll be a lot of broad sectors of the economy where I think that there's these genuine questions about where valuations are ultimately going to settle out in this world of very different finance costs relative to 2021 expectations, is in sectors like technology, where you had extraordinarily high multiples for subscription-based software, digital applications, some medical technology. I think those are areas where, again, this may be a 2-year period before people really feel comfortable having a sense of where the valuations are going to stabilize. But for much of the rest of the economy, I think that the deal volume growth is going to be, I think, really surprising people. I mean, if you scale M&A activity relative to the size of the economy or relative to the price level, we're still down about 42% from long-term averages. So this really could be very meaningful growth from 2024 levels.
So deal activity comes back, Jason, but does the IPO market, because this has been a venue for exits that has been really challenging for GPs, this idea that unless you have a big cap tech company that does something with AI, it won't be treated well in this public market. Do the animal spirits, does M&A coming back also reinvigorate the idea of being able to exit some of these down cap companies into public markets?
I do. So when you look at M&A, if you look at the IPO market, the reopening of the IPO market, of course the underwriters have to set a target to try to generate a pop for those IPO investors. Historically, 8 to 20% trade up in the first week. The 2021 IPOs performed so poorly in secondary market trading over the subsequent 2 years. I mean, I think peak to trough down an average of about 70%. So these IPO anchor investors, not much appetite. So the IPO underwriters had to give progressively lower guidance for sellers, for sponsors. I think that's changed quite dramatically. We've seen, we've completed 2 IPOs over the second half of 2024, and the price guidance, the price targets was acceptable to us, I think acceptable to sponsors, sufficient return, but then also sufficiently low to actually build this very strong book of IPO investors. So again, I think that when you look at what predicts IPO activity, it is the secondary market trading returns of prior IPOs. As more IPOs perform well, I think you're going to have more and more interest from IPO investors.
Jason, I just got to assume this has got to be music to investors into private equity funds' ears. The LPs who've been clamoring for basically the past year saying, you need to exit investments because you need to get cash back to us. So it's finally happening, but do you think that changes behavior of investors, of LPs, just having gone through this period of having their cash frozen, of not getting it back? Will it change and have maybe some reticence in how they invest and where they invest?
What I think has been so interesting over the past year is the way that investors increase their allocations to credit, and with good reason. At the end of 2023, broadly syndicated loans were yielding 10 or 11%, private credit 12 or 13%. That's well in excess of most institutional capital pools' target equity returns, which are generally 9% for stock market allocations. So you're getting higher returns, but of course less risk because you're investing in these securities that sit at the top of the capital structure. This is largely what has led to what you could think of this supply-demand imbalance. All of this money in credit seeking in opportunities where the M&A volumes have not been sufficient to generate the net new loan growth to absorb all of that capital. So that's the origin of the spread compression. And that is effectively what has unlocked, in my view, this M&A boom because of the way it's reduced finance costs, the way that the spread compression has, again, more than offset, in many cases, the increase in base rates. So interestingly, it's investors' allocation decisions moving towards credit that has actually planted the seeds for this looming boom in M&A activity in 2025.
Jason, what would be your advice then about Andrew Ferguson to individuals that are looking at, getting involved in the M&A space in 2025?
I think in Washington, I do think there's still going to be some significant scrutiny of mega cap tech acquisitions. I think that it's broadly shared in the policy community that some of the acquisitions made may have dented competition. You know, instead of having standalone companies like Instagram, for example, or YouTube, the consolidation perhaps was something that, again, if you had a chance to go back and rethink, that there may have been more scrutiny applied to those deals. So I think that there's going to be, again, a change in policy attitudes so that there is a continuation of the scrutiny of mega cap tech, we'll say. But for the rest of the economy, I think you're going to see merger guidelines, attitudes towards business combinations, you know, that are very dramatically shifted relative to the past 2 years, where I think in many cases it was just deep skepticism about virtually any business combination that was proposed or considered.
Jason, before we let you go, just real quickly here, how much could you see this M&A boom be, given the fact that everyone's kind of putting out their proclamations of just how big 2025 could really end up?
Again, I think when you scale dollar volume of M&A activity relative to GDP or relative to the price level, relative to market capitalization, just getting back to longer-term averages would be consistent with a 50 to 75% increase. So again, it's important to appreciate just how depressed activity has been. Again, I think much of this is just this real option of waiting, this sense that we're going to have better financing conditions in 12 months, no sense in acting now. And finally, that has been played out. Now, the time to act is now. The potential for higher rates in 12 months is something that I think every would-be acquirer, every would-be seller has to seriously contemplate today.
Jason Thomas of Carlisle, thank you so much for your time. Have a great weekend. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yaira Hackes. Yaira.
Hi, Lisa. Elon Musk and the SEC are back at it. Musk posting a letter on X that said the agency has reopened its probe into Neuralink this week, but it did not say what exactly it's investigating. The letter also said the SEC is preparing to take action against Musk regarding the timing and disclosure of his purchase of Twitter stock before acquiring the company in 2022. According to the letter, the agency gave Musk a 48-hour deadline to accept a settlement over the probe or face enforcement action. The SEC declined to comment. Meanwhile, consumers are still going big at Costco, with the retailer reporting better than expected earnings. Membership rose at the retailer, which is known for selling items in bulk at a better value. Plus, it saw a more than 7% rise in comparable sales at stores, while online sales also grew. On the earnings call, executives said furniture has fueled e-commerce sales this holiday season. And YouTube TV customers are in for a surprise. Starting on January 13th, new and existing customers will be charged $82.99 a month, with the company citing the rising cost of content for the change. When YouTube TV launched in 2017, the streamer charged $35 a month, but from there, it got incrementally higher. In 2019, it reached $50, and then last year, it was hiked to $72.99 a month. At this point, you may as well get cable. That's your Bloomberg Brief. Lisa?
Thank you so much, Yaira. And they say inflation's dead. Up next, the Fed's Trump strategy.
We don't know what the timing and substance of any policy changes will be. We don't guess, we don't speculate, and we don't assume.
That's next. This is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Heading to Wednesday's Fed meeting, under surveillance this morning, the Fed's Trump strategy.
In the near term, the election will have no effects on our policy decisions. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume.
We do, though. Here's the latest. Fed Chair Jay Powell holding back from making predictions about the economic impacts of Trump's policies, emphasizing the need for more clarity. Former New York Fed President Bill Dudley writing in his new column that just dropped across Bloomberg, the Fed can and must at times make assumptions about what politicians will do. When the Trump administration's tariff and deportation policies come into focus, that outlook may become less rosy. Bill Dudley, I'm so pleased to say, joins us now. Bill, thank you so much for being with us. Let's just talk about how a Fed comes up with a dot plot looking into 2025 without making some assumptions about what the policy backdrop is going to look like.
Well, I think they are going to make assumptions. I think they're going to assume that the 2017 tax cuts do get extended. So I think what Powell said at the last press conference, we don't guess, speculate, assume, is actually contradicted by what they actually did in December 2016 when they did include the fiscal policy stimulus that they thought was going to be enacted by the first Trump administration. That was in the forecast. So I think, they have to assume it when it's big, when it's likely, when it's sort of clear what it's going to be, and when it's priced into financial markets. And I think that's true for the extension of the tax cuts. It's not true for tariffs or immigration policy because it's very uncertain about what those policies actually will be at this point.
Bill, do you think that that's why it's more important to look at, say, tax cuts than some of the other policies that could potentially have contradictory effects on inflation and growth?
I think the real problem on tariffs is you don't know how big they are, how long they're going to last, whether there's going to be retaliation. And on deportations, you just don't know the magnitude or speed of what the program is going to be. And so if you don't know what it's going to be, it's really hard to put it into the forecast in terms of its likely effects.
Well,
so I think the tax cut assumption is going to be in there, but nothing else.
Well, when it comes to tariffs, the September 2018 Teal book talked about the fact that in the first iteration of Trump, they just saw the tariffs as a one-hit threat. Do you agree with that assessment? And do you think that would still hold today for this FOMC?
I don't think they're making any assumptions on tariffs yet because we just don't really know what the administration is going to do. I think the big difference, though, the tariffs that were done in the first Trump administration were actually relatively small. The total tariff on imports went from 1.5% of imports to 3% of imports during the first Trump administration. We're talking about much bigger numbers now. We're talking about 10, 20%, 60% against China. So the magnitude may be much greater, but we're not really sure. Is this just a threat, or is it actually going to turn out in terms of substance?
So, Bill, what we essentially have is just the incorporation of tax cuts and missing out on two key pillars of Trump's policy going forward, immigration and at the same time tariffs. I know that this is a sacrilegious question, so you'll have to forgive me, but are the dots even useful this time around then?
Well, I think what's the problem with the dots is you're going to have an unusually rosy forecast because it doesn't include some of the more controversial economic policies that could really change the outlook with respect to growth, inflation, and productivity. You know, higher tariffs, deportation is going to be disruptive to the economy. It's going to tend to push inflation up. It's going to push growth down. And that's just not going to be in the forecast.
At this point, Bill, what's your base case for how they're going to sort of telegraph some sort of pause or some sort of adjustment to the process of rate cuts in 2025?
Well, I think it'll be done in a couple of different ways. Number one, the number of rate cuts that they show in 2025 will go down from last time. Last time in September, they had 4 rate cuts, 425 basis point rate cuts in 2025. So this time will be 2 or 3. And second, I think Powell will talk about how, you know, inflation is a little bit sticky. The economy is doing really well. You'll probably see some upward revisions of the Fed's estimates of so-called R-star, the neutral rate. So I think all those things together will make it pretty clear that, you know, January is probably going to be a pause. And that's really what's priced into markets. Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
Bill, what's your take? If you were on the FOMC, where would your dot be? What would you be looking for next year, and what the bigger concern is, inflation or weakness?
Well, I think the big place where I would probably diverge from the consensus of the committee is on R-star. Right now, the median estimate of R-star is 2.9%. So the Fed is basically going to show the federal funds rate going to 2.9% in the SEP, not in 2025, but in 2026 and 2027. I'd have a higher R-star, probably something in the order of 3.5%, maybe a little bit higher. So I would not have as much cumulative easing of monetary policies as what the Fed will have.
And that seems to be where the market's at right now, certainly, as well.
Absolutely.
Former New York Fed President Bill Dudley, thank you so much for being with us. And really, that's going to be the key question, Danny, going forward, is just how much do you see a readjustment of what this new reality of a neutral rate really looks like for this Federal Reserve?
And how many tools does the Fed have if they are in this position where they're giving policy, they're giving the dots, and the market's going to look at that and, to Bill's point, say, I think this is a more rosy estimation of what it will actually be because we know you're not incorporating certain things. It kind of limits the ability of the Fed to give policy via communication. If the market's willing to just write it off and say, we have a very different idea of where things are going.
Well, this is why Evercore ISI, in a note out this morning, is talking about this hawkish cut, because it's going to be a cut, but then it's going to be very dicey and difficult to understand what they do going forward for 2025. And to Bill Dudley's point, that might mean a pause in January.
Yeah, but a hawkish cut and still saying the neutral rate is like 3% or 3.25% might not be so hawkish for a market that's moved well ahead of that. More to Bill Dudley's side of things. Coming up, John Stoltzfus of Oppenheimer with the biggest bullish call out there so far for 2025. Mandeep Singh of Bloomberg Intelligence, Claudia Sam of New Century Advisors, and Rick Reeder of BlackRock as we look to a yield space with yields higher across the board. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Flow into U.S. equities so far this year. It is on track to be an absolute record, with the U.S. dominating all flows that we've seen across the board. I love that Chris Harvey note. I just keep thinking about it. basically driven by this wish to be contrarian. You understand why they want to be contrarian, though, at a time where there's such an overwhelming consensus.
It's uncomfortable, and you bring it up all the time. The fact when everyone's on one side of the boat, is something wrong when you look at this picture? But research note after research note, looking into 2025, everyone is saying, no, you have to be a part of this rally. It has not stopped yet.
I will say I'm seeing so many more qualifications in research notes to end the year than you usually do. It's like, okay, we'll do really well in 2025. Maybe 2026 we'll get some disruption. Or maybe we'll do well in the first half and then pull back a little bit. Or we think it's going to be 7,000, but hey, our worst case scenario is 2,000 points less than that. There's a lot of qualifying and, making sure if things go wrong, you have your bases covered.
There's going to be a bubble in 2029, but bye in the meantime. Coming up, and not that, John Solfis of Oppenheimer as the rally takes a slight breather, but he has the biggest, boldest call on the street. Claudia Sum of New Century Advisors on the U.S. economic outlook for 2025. And don't miss this, Rick Reeder of BlackRock looking ahead to that final Fed decision of the year. We begin this hour with stocks higher, investors parsing mixed inflation and labor data, looking ahead to the Fed and next year. John Solfis of Oppenheimer, the most bullish on the street, writing this. Fundamentals suggest to us further upside for equities based on current stateside monetary policy, the resilience in economic growth, business activity, the consumer and job creation evidenced in recent years. We initiate a price target for the S&P 500 by year-end 2025 of, drumroll, 7,100. John joins us now. John, thank you so much for being with us. You were the biggest bull.
Lisa,
you were the biggest bull last year.
I love the drum roll. I thought that was great. We really take this setting the target very seriously. Although we really think the most important part of it is stating what we expect the direction of the markets is going to be. And in this particular case, it really does look like the fundamentals are intact. You've got a business-friendly administration coming into the White House, as well as, at least on a marginal basis, Congress, is essentially more business-friendly outlook, it would seem. And then you also have the bond market, which applies discipline. If the Fed, I think, relies a lot on the bond market to make some of its statements related to inflation when it's stickier. And the judgment that it might place, and usually it's the 10-year that provides the signal.
John, I'm looking right now at the upside for the 7,100, and it points to a 16% upside from the time when you initiated this. You were the biggest bull last year, and it wasn't bullish enough. And it raises this question, why stop at 16%? Why not 25%? What about a doubling?
Well, we're not gunslingers. The old thing in the days of in the 1960s and the 70s, they used to call the mega bulls at that time gunslingers. We're not looking for a perfect world, peace on earth, or anything that would be unrealistic based on history of the last millennium. But we would have to say we are looking for a Fed that remains very sensitive in terms of the economy, both related to both sides of its dual mandate in terms of the quality of the economy with inflation in check, and yet not pushing unemployment to levels that would be concerning. And then business, the consumers, job growth, even if you see some slowing or at times some guidance that is rather cautious, all in all, looks pretty good to us. We think it's a continuation of what we've seen, but not necessarily at the pace of picking up another 20%. But we'd be glad to ratchet this target higher if the S&P would close at 7,100. We'd at least consider ratcheting it higher.
Fair enough, John. I just wonder, though, how do clients feel about this? Have you gotten any pushback of people who have said, John, you're bullish, everybody's bullish, I'm worried everybody's bullish?
Danny, I think they hear from me very often that if one thing that does concern me is that so many bears have capitulated and are on our side of the boat. But that said, I've been in this business for 41 years, so I came in to this business during the second term of Paul Volcker, which was, a scenario of much higher interest rates, much higher inflation, and all the drama that developed through that. So I bring a certain amount of context. That doesn't mean our calls are always right. But our clients, over the last 12 years that I've been with Oppenheimer, have heard me speak a lot. They have a lot of access at Oppenheimer to our viewpoints and our publications and client events. People are remarkably calm, though they're very realistic. They're well diversified. They know what they own. They know why they own it. And they have right-sized expectations of how their assets are going to perform as the economy works things out, as the Fed directs the economy towards its 2% target.
So, John, as we head into another year by your accounts, that's going to be a good one for equities. Does leadership in 2025 look different than 24?
Leadership, we do expect a continuation of the broadening, but very much in some ways, the market has been sort of like a python digesting things. So you watch the digestive process as it moves forward. You get a broadening, then a narrowing, broadening, and a narrowing. And so we've seen since the lows of October 2023, the market has had periods where it broadens, it goes through, it gives, it share. You see the Mag 7 share the stage in terms of performance for a period. With other sectors, you get the other 10 sectors, you'll see them perform to some extent. Mostly 9 of them, energy really hasn't been a great participant in that area. But what we're seeing is that it even goes to market capitalization style, growth versus value, though growth has been favored all year. There are periods where all of a sudden you'll get some growthier value, will have a good bid placed on it. In addition to that, other than style and market capitalizations, cyclicals continue to outperform defensives for the most part.
John, when it comes to your research, we all know you're a bull, but you do say you think the legs are strong enough to climb this proverbial wall of worry into and through 2025. Can we talk about, though, what are some of the worries you're concerned with?
Well, I think some of the worries are just what we've heard from guests on your show earlier this morning. The question is, will the administration use tariffs as a blunt instrument, or will it use it as a negotiating tool in a world in which the U.S. is the buyer of choice? On Wall Street, if we were going to give a Wall Street definition to the U.S. economy, we're buyers in size as consumers. And so that in itself, I think, offers a negotiation strength for the administration in just trying to remove some unfairness within the global competitive landscape, as well as look to bring some businesses back that are important for national defense and healthcare, for example, I think are important. But I don't think we're looking at a picture that's as dramatic as many expect. I also think the geopolitical risk, of course, remains significant. Sociological concerns, within the United States, as we just saw, related to the killing of the head of a large insurance company. All of that has a sentiment of value that's important to consider. But related to the economy, I think the most important is that business is doing what it needs to do. The consumer is doing at a slower pace, but showing to be a consumer that is more sophisticated than ever before, probably because of the financial media. I mean, Bloomberg educates people, and so do some of its competitors as well, and that makes a difference.
Well, thank you so much, John. Everyone around this table appreciates that. Your first concern there in that wall of worry was tariffs. I know you also love this genuine potential for AI. So do you think AI can trump some of Trump's policies?
I think, Anne-Marie, that when it comes to AI, I think the value of AI is what it does for the other 9 sectors other than technology, to increase efficiencies and operations, and for the consumer to increase efficiencies in their dealing with the companies they buy services and products for. And all that to us looks like contributory to a more economic strength, better opportunity in terms of new types of labor, and we're in the early innings of it. So we're believers in AI. We're you know, all the moonshot stuff, we'll wait to see how all that works out. But on a day-to-day basis, we think managements that are suitably placed to grow their companies and benefit their shareholders, their customers, and their employees are investing in AI. And we think it's progress, and we think it's watershed quality progress that probably is parallel to where the automobile was in the 20th century after Henry Ford had mechanized the assembly line and brought down the price and increased the quality broadly. It changed the way people lived.
John Stolfus of Oppenheimer, thank you so much for being with us, and happy holidays. We'll see you on the other side. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The Trump transition team wants to drop a car crash reporting requirement for autonomous vehicles. That's according to Reuters. This would particularly benefit Elon Musk's Tesla, which has reported more than 1,500 crashes to federal safety regulators under the program, according to the report. The move could hinder the government's ability to investigate and regulate the safety of vehicles with automated driving systems. Meanwhile, Donald Trump's team could be looking to make banking regulation a thing of the past. The Wall Street Journal reporting that officials from Trump's Department of Government Efficiency have talked about shrinking, merging, or even eliminating agencies like the FDIC. Bank executives are hopeful the Trump administration will ease regulations on capital requirements and consumer protections, but any proposal to get rid of an agency would still need congressional approval. And the Container Store is preparing to file for Chapter 11 bankruptcy in the coming weeks. The move follows mounting losses and escalating liquidity issues at the retailer, according to people familiar. The company had been in talks with lenders to provide capital for growth, but have pivoted to focus on restructuring efforts. The Container Store operates 103 stores across the U.S. and holds nearly $230 million in long-term debt. That's your Bloomberg Brief. Lisa?
Thank you so much, Ira. Container Store, I don't understand it. I know that you understand it, but I kind of felt like if you wanted to organize your stuff, why buy more stuff? I don't understand.
But you know what it feels like when you were a kid and you did back to school shopping and you got like cool notebooks and cool, that's like the Container Store is the adult version of that for me. Like, ooh, pretty things to put in the house, to put other things in.
You don't Marie Kondo your closets and your kitchen?
Things out. I don't actually try to buy new plastic things. Well, anyway, I digress.
Too logical, Lisa.
Up next, the morning calls. Plus, Mandeep Singh on Bloomberg Intelligence as Broadcom soars on anticipated AI demand. That's coming up next. Right now, Broadcom shares up almost 17%. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East, and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back. This is Bloomberg Surveillance with stocks higher ahead of the open. Futures just up about 0.4% on the S&P. You can see across the board pretty slow action, although the euro bouncing after yesterday's tumult, I should say, after the ECB rate decision. 10-year yields higher again, crossing that 4.34% threshold in the United States. Time now for the morning calls. First up, Barclays upgrading Norwegian Cruise Line to overweight, citing confidence in underlying demand. Next up, JP Morgan downgrading Toll Brothers to neutral, expecting a less supportive backdrop for the home builder next year. And finally, KeyBank upgrading Salesforce to overweight, saying it is optimistic about the company's AI platform, Agentforce. So let's stick with AI, as it's going to be a transformative force similar to the creation of the automobile, as we were just hearing about. Broadcom rallying after predicting a boom in demand for AI chips. The chip supplier for Apple and other big tech companies saying AI products will gain 65% in the first quarter of 2025. Joining us now to discuss is the one and only Mandeep Singh of Bloomberg Intelligence, who always provides us with incredible insights. What did Broadcom get right in its guidance, given the fact that its numbers did not necessarily outperform to such a big degree?
Yeah, so you're right, the numbers were in line, but what they gave us was the runway in this market with their existing customers. So the three hyperscalers, which are their customers, Google, Meta, and I think it's ByteDance as the third one, their addressable market is 15 to 20 billion. They said that addressable market is going to expand to 60 to 90 billion just from these hyperscalers. That's huge. And think about it. The two of these customers are also customers of NVIDIA. When they say hyperscaler exposure is 45%, they're counting Google and Meta as customers. So the fact that Broadcom is so optimistic about the ramp up of these customers on their platform, it just goes to show that if Google is building a 1 million cluster of their TPUs, they're using Broadcom, and probably they are moving away from NVIDIA to an extent, but they could use both. And that's the real takeaway here.
That's where I wanted to go. How much is Broadcom an alternative to NVIDIA? How much is it parallel? How much is it being used by the likes of Apple to diversify the sources of their chips so that they're not so dependent on one company that keeps jacking up the prices for them?
Yeah, so think of the biggest AI cluster right now. It's about 100,000 GPUs. What Broadcom said last night is we will have a 1 million TPU cluster or a GPU cluster over the next 3 years. Now, whether it's GPUs or it can be any ASIC, which is a TPU or any other custom chip, Broadcom is betting the latter because that benefits their business. GPU is more of a standardized chip for AI. Broadcom is saying every hyperscaler will build their own custom chip. And that's where, you don't need to buy everything from NVIDIA, networking, GPU. You can customize the workload and buy the chip from Broadcom and then customize it the way you want. And I think that's a big bet they're making with the hyperscalers. Remember, the 60 to 90 billion is just for the hyperscalers. They're not talking about the entire AI market. They're just saying these hyperscalers are going to spend 60 to 90 billion in the next 3 years.
Well, maybe not for AI, but some of the other chip components, you've seen the likes of Apple try to bring that in-house and away from Broadcom's, things like their Bluetooth and their Wi-Fi. What does that do to a Broadcom? Do they start to move away from some of the more legacy businesses as tech players bring those internally?
Yeah, so that's always the risk for Broadcom. Right now, Apple is their largest customer, 20% revenue exposure, but that's more on the iPhone side. Apple is also ramping up on the data center side. In fact, they called out 2 new potential customers, and Apple and OpenAI were 2 of them. So OpenAI could make their own chips. And that's where Apple moving away is not that big of a threat because they will end up ramping on the data center side. And so I think the custom chip is a real opportunity, and Broadcom is the player that's positioned the best.
Earlier this year, though, there were concerns in one of their earnings report about too much revenue coming from China. Have they been able to diversify more?
So that's a real risk. I mean, nobody knows what will happen when it comes to tariffs and how these companies get impacted. I said ByteDance was one of their existing 3 hyperscalers. I mean, imagine what could go wrong in that situation. So clearly that is a risk. But I think that risk is for NVIDIA as well as for, some of the other companies.
But you mentioned ByteDance. They're literally working with ByteDance. ByteDance owns TikTok, and that might be banned in the United States after January. So is Broadcom, would you say, the most vulnerable when it comes to these semiconductors?
I mean, given the size of their AI revenue is around $12.5 billion right now, and you could say maybe 25% revenue exposure to ByteDance. So they have a sizable exposure, but I think Apple has the toughest challenge when it comes to China. So yes, we may think Broadcom is exposed as well, but I think there are a number of other players that are exposed to that situation.
Mandeep, one of the other risks that people love to talk about because they want to be contrarians or for whatever reason is the idea that they're really exposed to the hyperscalers and they might slow down their spending. It was interesting to listen to the CEO of Broadcom talk about the next 3 years and the potential of that. Do you think that put to bed some of the concerns of the spending petering out?
Absolutely, and if anything, CapEx, they said CapEx could grow up 35 to 40%. Broadcom said they will exceed that 35 to 40% growth ramp in the CapEx of the hyperscaler. So if anything, what they're telling us is Broadcom will grow faster than potentially NVIDIA at this point, given NVIDIA has a larger base. But the fact that he's so confident that they'll grow faster than 35 to 40%, it just tells you how much visibility they have in terms of the CapEx ramp from the hyperscalers.
Mandeep, how much has the world of AI shifted in 2024 when it comes to who the leaders are and who the leaders are set up to be in 2025 at a time where you see Broadcom making these inroads, you see NVIDIA slowing down, and then you see a couple of the players really not put in the performance that a lot of people were hoping for?
Yeah, I mean, look at the shift. Intel's, CEO having to leave. So clearly there are some market share shifts that are happening, and that will happen. I mean, some of these new applications that will be built on generative AI models will be very disruptive to existing businesses. But look, I think everyone was worried about some CapEx digestion. I don't think we are getting that. I mean, these companies will continue to invest in building bigger clusters, and the scaling laws are still applicable. So right now, we are still in that, second, third innings when it comes to Gen AI.
Mandeep Singh, thank you so much, as always, for taking the time. Mandeep Singh of Bloomberg Intelligence. Just noting that a lot of people looking at artificial intelligence to interpret Fed speak, and I got this from Deutsche Bank. We asked our AI tool to grade the degree of hawkishness of the ECB press conference, and they came out that AI finds no signal beneath the surface consistent with an imminent 50 basis point cut. This is the new thing. It's sort of Fed speak reader in ChatGPT.
Yeah, but we all could have told you that. I mean, how great are these insights? We all could have listened to Lagarde. I guess it saves you time of not having to do that. But I want something real and unique and something you couldn't have just gotten, maybe taking signals from, I don't know, like her brooch or something.
Exactly. That's what I was going to say. Her brooch sometimes signals whether or not she's going to be dovish or hawkish, and I'm not sure AI is able to glean into that.
You can add that to your models for AI. Coming up next on her models for AI and other things, Claudia Sam of New Century Advisors with real insights into what to look for in next week's Fed meeting, as well as, of course, the dots. And Rick Reeder of BlackRock, as we do see yields inflecting higher past a couple of key technical levels. How much does this signal the path of least resistance is higher, not lower, or does it signal that it's in the end of the year and things are messy? This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Futures looking rosy on this Friday the 13th. After a week of losses, can they climb out? We're seeing those gains escalate heading into the open, up 0.4%. NASDAQ futures up now almost 0.9%, 1 hour away from the cash open. Let's get some of the specific components with your morning movers. Here is Manus Krane. Manus.
Lisa, good morning. Look, one big alpha in sentiment this morning is coming from Broadcom. When you have, as Mandy just said to you, a confidence in the visibility, a confidence in the CapEx visibility, that is what Broadcom is telling the market this morning. Not only do they see their AI products up by 65% in this quarter, but it is about the guidance through to 2025, a market, an addressable market of somewhere between $60 to $90 billion. So for every product they deliver, they're really chasing into a growth market. Margins of 66%, dividend uplift of 11%. This is a monster announcement from Broadcom, to the extent that Bank of America shift the gears on the stock price up to $250 from $215. It's all about the AI opportunity. Snapshot of PayPal. This is what we got for you. There are 220 million. This is a staggering stat. The biggest wallet outside of China sits within the PayPal family. How do you monetize that? How do you upgrade that? How do you take the journey from a 4% growth rate this year to mid to high single digits next year? That's what they want to know from the Investor Day. I'll leave you with a snapshot of RH. This is, despite the worst, in their words, the worst housing market in decades. You've got a 24% ramp in demand in November. I wasn't part of it. December, up 30% month to date. And not only that, but they give a gutsy guidance. How many CEOs out there can come out and say, doesn't matter what the tariffs are coming from China. We are diversified. We've removed ourselves from that fray. We've got a supply chain that's intact. This is a gutsy guidance from RH. Great kit, by the way. Lisa.
Thank you so much, Manus. Have a wonderful weekend. Markets digesting mixed data ahead of the final Fed meeting of the year. Bloomberg Economics expecting this week's CPI and PPI data will result in soft core PCE, opening the door for more easing. Claudia Sahm of New Century Advisors writing this: markets greatly overestimated the number of Fed cuts this year, but not the Fed. They were more cautious about disinflation in the second half of 2023. Caution will be a Fed buzzword for 2025, but it's evergreen for the Fed. Claudia joins us now, and thank you so much for being with us. Happy holidays. I want to start there, Claudia, the idea of what does caution mean at a time where, for some people, it means potentially even pause for the entire first half of 2025?
Right, so at the Fed, a big piece of the caution is they are, to their core, data-driven in their monetary policy. And we know, after having watched the data very carefully with them all year, the data are messy. And so that is part of, they want to see the good news when we see the disinflation, like we did a lot of disinflation in the second half of last year, but they don't necessarily want to extrapolate that good news. So I think we rounded out the inflation data for this year in an okay place, right? We saw numbers that were okay, particularly after we brought in the producer price index, but they're not great. And so that's where the Fed they will have done a percentage point of cuts this year if they go forward with the 25 basis points next week. That's not nothing. right? But they're going to then take a break, see how the data lays, see if this inflation, the good news, continues, and then keep going. But they're not in a hurry, and I think that is a stance that has largely served them well.
Claudia, do you think that it was a mistake in retrospect, or that there will be a reversal of Fed Chair Jay Powell talking about how he would not welcome any further weakening in the labor market?
Oh no, I think this is still a dual mandate Fed, as they should be. That is the law. I think that's one thing that makes the Fed very hard to read. Like if you look back at their projections from a year ago, and as I'd said, they were pretty close really on the cuts that they did this year. They actually did a little bit more than they had expected, and yet their forecasts and other pieces were had some big misses. And so there's not a simple reaction function. Like the Fed's job with the dual mandate of stable prices and maximum employment, that is a very tricky job. And so they, in addition to being cautious, they are known to, and have been, and we saw it this year, nimble in their decision making. And they have shifted off at times, concerns with the labor market and concerns with inflation. And that, I think, is a theme we will absolutely see going forward into next year, because inflation, we've made a lot of progress, and the labor market has cooled off a lot. So that is going to keep coming back as a theme.
Well, the shifts might need to happen even more, Claudia, just because we don't know what type of fiscal policy we're going to be getting, or at least the details of it. What does that mean for the summary of economic projections? This time around, how useful is it to look at for a guide of 2025 if, in the words of Powell, they don't assume?
Right, so I think the summary of economic projections is going to be of limited use. I mean, I think they're generally of limited use, but it is unlikely that Fed officials are going to build in their guesses on fiscal policy. And so that means it's more of a read of after the inflation data we've had, and there's been a lot of discussion about disinflation stalling out. Like, are we in some problem space right now? And they're probably going to pencil in a little bit less of interest rate cuts next year, and that's going to be reflective of the data that we have in hand right now. And it is not going to be telling us what they think about the fiscal policy. And honestly, like the 2025 forecast probably can get away with it. Right? It's going to take some time. We're going to get a real blast of words about fiscal policy and some initial reactions. But by the time it feeds into the economy, which is where then the Fed is reacting to it, that's going to take a while. So like that especially the out years of the projections that we'll get next week, they're really not worth the electronic paper they're printed on.
Well, we heard from Bill Dudley earlier, of course, the former president of the New York Fed, a Bloomberg contributor. He has an opinion piece out today, joined us on the show, and he said, you know what, Powell might actually have to walk back that assertion that we don't assume, especially when it comes to tax policy. Could that be one avenue where you could see a little bit more of looser language, maybe in the press conference from Powell?
I don't think he has to walk it back. There is a real logic for the Fed not to get in the business of the putting in the fiscal policy. And frankly, if you go back and you read the forecasts and the details of them that they put together at the same time as Trump was getting ready to start his first term, they had the staff forecast had very loose assumptions about kind of placeholders almost of fiscal policy. And I think in a way that this time, because the tax cuts, a lot of it's extending and we don't know what is going to be added on, and the tariffs are a real wild card, both on what the U.S. does and what other countries do. Like, it's just like, why? It's like it would be the Fed creating noise. If they're putting in these assumptions and guesswork, and then they're front running the administration that hasn't even gotten to work yet. So I disagree with Bill on this one. I think Powell's going to kind of put his foot down and tell people don't put it in. We don't want it in this forecast.
Claudia Sahm of New Century Advisors, thank you so much for being with us. Happy holidays and have a wonderful weekend. Rick Reeder of BlackRock, looking ahead to next year's Fed outlook, writing this: several crucial factors for the U.S. economy appear quite favorable and constant in the years to come, although there are also a number of uncertainties that cloud the inflation outlook, as well as complicate the Fed's rate cut recalibrations. Rick joins us now. Thank you so much for being here. It's been too long.
Thanks for having me.
Rick, I'd like to start with this question of how much Fed policy drives what you find attractive right now at a time where the progress with disinflation seems to be at least calming down.
It's a great question. So I'm going to try and give an answer that's more clear than what you just read there. I was thinking through, I'm not sure where I wrote that in, but Listen, I think part of what I was describing, listen, the economy's in good shape. Economy, I mean, you look at, we're going to get retail sales. I think it's going to be a pretty good number. You look at the Thanksgiving sales, consumers in good shape. CapEx, we talked about Broadcom this morning. The investment that's going into AI, the CapEx, the R&D spend is pretty significant. So you got an economy that's operating at a good level. And as you said, inflation is, if anything, bending up a little bit. And so much of the progress. So now what does the Fed do? Listen, I think, and I agree with the way Claudia Sam described it, I think they got to go in December, and you're getting, we've been pretty adamant about get the funds rate to 4, get it to 4 because it's too restrictive and you're hurting lower income people when you're up at 5 3/8 and in those levels. Now you're there. I think you step back and say, let's see where we are, interpret the data, and I think it was a great question about, policy's going to change. What does strategic decoupling look like? What does deglobalization, what does tariff look like? What is the stimulus you put into the economy through deregulation? Boy, the range of outcome for GDP is pretty significant. I think your base case, economy's going to be in good shape. Economy is, if anything, the U.S. economy, different paradigm globally, but U.S. economy is in pretty good shape.
It raises this question of what's the bigger risk, credit risk or rate risk? It sounds like credit risk is not the biggest concern simply because if things are so great, well, credit looks good. At the same time, spreads are pretty tight, and you have to worry that maybe people are overestimating what the effect of some of these policies could be. So how do you sort of judge those two issues?
So I did a presentation yesterday where I showed that for the first time in decades, so the risk-free rate is more volatile than the spread, than the risky rate or spread sector. It's actually a remarkable point in time. And so normally when we build any asset, whether it's equity, debt, you think about what's my risk-free, that's your constant, and then you build your variables on top of it. The variables are actually much more stable today than the risk-free rate, particularly as you go out the yield curve. Listen, I think the front end of the curve is pretty well pinned. I think the Fed sits there for a while. Could you soften up a little bit from here? Maybe. But I think you're pricing in, a Fed that's going to, sit here for a little bit, try and get another couple of cuts done next year. The long end of the curve has got some of the term, first of all, term premium in the back end isn't enough at this point. And so, listen, I think you got some volatility out in the longer end that, around the economy that's in pretty good shape.
What would it look like to have enough term premium in it? How far away are we from fair value?
So, it's a tough question. I mean, one of the things that's interesting, so, people talk about we got to put on a curve steepener in the back end of the curve. The technicals in the back end are actually pretty good because there's so much sitting on the Fed's balance sheet. So the net float that's in the system, including when you take what pensions, life insurance companies own a lot of the long end. So, where would you buy it? My view today is there's not a big tactical, let's put on the steepener trade. I just feel like I can clip a ton of income in the front to the belly of the curve. We build this ETF called BINC where we're creating 6.25%, 6.5% yield. You can use reasonable quality assets, high yield, securitized, stay in the front of the belly and let other thrill seekers figure out where to go on the back end because it's just I just don't find it an asset. So think about it. If you have a portfolio, you can own long durated assets. You can own equities, or you can own the long end of the yield curve with not a lot of term premium, and the equity market's throwing off 18% ROE, growth of book value. So and a technology innovation framework that's pretty incredible. So it's when I pick my tools in the markets, long end interest rates is not one that I say, whew, let's stop at that one.
Well, there have been a lot of people who don't even want to get close to being a thrill seeker and have remained in cash-like instruments and have remained in those types of funds, even though there's been calls so often this year that there's reinvestment risk. You got to get out of cash. You're going to miss this move in yields. And that hasn't played out. Mm-hmm. Does 2025 change that?
So agree and somewhat disagree in that. Look at the high yield market this year. So the high yield market, is going to bang out 8.5, 9, 9.5, depending on where you are return. Pretty good. Spread markets have done really well. If you're staying in the front end, so this is the incredible dichotomy. Long end of the yield curve this year, negative return, but the 1 to 3 years, it's actually been pretty good. So listen, I think one of the things that's pretty historic about where we are today, at some point, the economy is going to moderate. I think we're a few months from that. But you can see a dynamic as you get to the back half of this year that you start to see some, particularly if you got tariffs, you would get some global slowdown. The real rate of return you're locking in today, this point about, gosh, you can build a portfolio, use some high yield, get a 6.5 yield. if inflation's running, let's say inflation bends up a little bit and we're running 2.5 to 3, that's still pretty darn attractive. And so this idea, does cash deserve a seat at the table? Definitely. It's a great risk mitigant. But gosh, if I can lock in these real rates, those real rates, every time you've had real rates in history that have reached this sort of level, if you took a 1 to 3 year time horizon, the returns are spectacular because at some point, Fed's got to get that real rate down because you can't create enough velocity in the system until you get it there.
Rick, you talked about the range of GDP expectations we could see with changing policy in Washington, D.C., but then you just mentioned inflation. How concerned about some of these policies might mean stickier inflation that lasts and is pervasive through 2025?
So, listen, I think at the margin, when we run our data and we look at where is inflation trending, we're pretty constant in terms of where we are. We've got core PCE next year at about 2.5, 2.6. CPI is a little higher than that because of some of the component dynamics to it. We think it's pretty constant. My sense is you're not going to see dramatic tariffs a la some of the things that get thrown out in terms of negotiation. But I think you have to assume, at least today, that the trend is a bit more inflation into your calculus. The one thing that I think is extraordinary, though, and I think people don't spend enough time thinking through, if you think about all this investment in AI, and you think about the productivity enhancement that's going to come through AI, we could talk about job replacement, we could talk about the ability for so many functions that are reduced. You can really have inflation that ticks up, incredible spend on data center, on energy, on cooling, ticks up and tariffs, and you can get a bit more in terms of inflation. You get this one-time adjustment up in price. And I actually think you're going to start to see it move the other way pretty significantly. The timing of that's pretty hard. Is it 9 months from now or 2 years from now? But I'm pretty convinced that's coming.
What gives you the conviction, though, that it won't be the blanket tariffs?
So I'd say a couple of things. I mean, one, the president has run under this dynamic of we're going to bring inflation down. There's a couple of things that happen when you put pervasive global tariffs on. One, they're very hard to implement. Two, there is a tangible growth dynamic on the other side of that. Once you create that sort of abrogation of global trade, you get a near-term slowdown that can be pretty significant. We look at industrial production and how much that can come off. So gosh, I think my sense is you'll get a series of negotiations. You'll get some bilateral tariffs, depending on who negotiates where in the world. China is clearly a place you would think you're going to get some more significant tariffs. But boy, the impact of doing that globally, really has an impact on the U.S. I did an analysis yesterday of Mexico, Canada, and cars. You think about the incredible traffic back and forth in vehicles, trucking, petroleum, refined fuels. Like, boy, oh boy, if you cut that off of any significant magnitude, the impact it has on growth and inflation can be significant.
Rick Reeder, you're going to be sticking with us, which I'm very happy to say. Rick Reeder of BlackRock. Hanging around right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Russia launched a massive airstrike in Ukraine this morning in what Kyiv described as one of the largest attacks on its power infrastructure since the war started. Ukraine's President Zelensky saying on Telegram that Moscow fired almost 200 drones and more than 90 missiles, 81 of which were intercepted. According to the International Atomic Energy Agency, the attack forced Ukraine to reduce output at 5 of its 9 nuclear reactors. Meanwhile, President-elect Donald Trump met with the leaders of the International Longshoremen's Association yesterday. In a social media post, Trump expressed his support for the union and criticized automation, saying, quote, "The amount of money saved is nowhere near the distress, hurt, and harm it causes for American workers." Union members, which walked off the job earlier this year, may strike again in January. And Fox Business reporting that OpenAI CEO Sam Altman is donating $1 million to Donald Trump's inaugural fund. Altman reportedly saying in a statement, quote, "President Donald Trump will lead our country into the age of AI." The commitment will reportedly come as a personal donation from Altman as opposed to from his company. It follows separate $1 million donations from Mark Zuckerberg and Jeff Bezos to the inaugural fund. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, setting you up for the week ahead, this is Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Counting you down to the opening bell, here's a trading diary through the next week. Monday, S&P Global PMIs. Tuesday, retail sales. Wednesday, this is the big day of the week. A Fed rate decision at 2 p.m. Eastern, followed by a Chair Powell news conference. Thursday, another round of jobless claims and rate decisions from the Bank of England and the Bank of Japan. Friday, core PCE and University of Michigan sentiment survey. Rick Reeder of BlackRock still with us, and you were saying something that I found so interesting before about how you get income now from stocks more reliably, potentially, even than the long end of the yield curve. Does that destroy the idea of 60-40?
I mean, I think, see, you know, if you think about what 60-40 was, or, you know, the long end of the yield curve was your ballast in the portfolio, was giving your hedging potential, and it worked. You know, by the way, it worked for years when inflation was coming down from where it was in the 80s and 90s. Today, it's a very different. I mean, if you said to me, gosh, I own equities, what would I do with my equity portfolio? First of all, I believe equities are where you compound growth. Like, and particularly today, the ability to compound growth is extraordinary. And your ability to stay in these equities, compound growth, you think about pretty spectacular year in 2024. I think if you go into 2025, you're still throwing off 18% ROE, compound that growth. Then I'd take my income and I'd say, gosh, you know, we're talking about real rates and fixed income. If you stay in this 1 to 5 year part, I get a lot of income. If I can create a 6, I compound that income, I get my growth from equity. And they say, well, what's my stopgap? What's my hedge? Equity volatility is incredibly low. Your ability to actually manage a risk portfolio and then optimize where you're compounding growth in the equity market. I mean, you know, when I say you get income from equities, I think you get income because you're getting total return appreciation. You know, when I buy a lot of dividend stocks that are slow growers, like, I don't know, if I can get 6.5 in fixed income and I'm at the top part of the capital stack, I don't know, feels okay to me. And then like try and optimize. You know, I think fixed income and equities are really different. Fixed income, I feel like diversify, get as much yield as you can, manage it efficiently. And then in equities, you want to like, you know, what are the companies that are going to take you to the next level, particularly in an era like this that is strategically evolving so quickly?
Rick, does this feel like a permanent shift? Because this is very different for asset allocation. The idea that you can't have some of these bonds as a haven, as a ballast. Is this just a here and now, or is this a reconsideration this entire industry needs to go through?
Wow, it's a great question. So, you know, you can't say never, but, you know, in the near term, I mean, one of the cool things about the industry, I've been doing it for so long, is there's so many tools now to create precision in a portfolio. You think about the growth of ETFs, futures, derivatives, and obviously cash products and new cash products. You know, the regime shifts. Every year we spend a ton of time trying to think through what's the regime for the next year, and then what are the tools that you utilize? Listen, I think, the traditional interest rate tool, listen, I think there's so many. By the way, if you want, like you think about an index, gosh, I get the aggregate index, but I'm getting a bunch of stuff in there. Do I really need it? I've got some long end, I've got some tight spread assets. I can buy an ETF now if I want duration, and I think now we're turning the corner. Rates are coming down. Gosh, I've got it. There's a long end TLT, there's some long end ETFs. Like I'll get there, I'll get my duration that way. Maybe I bring my beta down in my portfolio through, in equities. We talked about options. We talked about other ways you reduce beta in equities. But I just think we're in a new era where you can manage a portfolio in such a sophisticated way because there's so many tools at your disposal.
What is the yield level, just quickly here, that you would find long end yield curve attractive again?
I don't know. It's life changes everything. You got to think about things, but it's not. I don't know. I'll give a level because that gets stamped. But I think they're. I don't think you're there today, and I think you got to see. Over the next couple of months, is a pretty good non-answer like that first quote that I had.
This is good.
I think that. Listen, we got to see. There's going to be a point in time that we're going to start to see inflation. That productivity enhancement, that automation effect that's going to come in, and then we'll start to buy some back end assets. It's much more about the environmental condition than pick the number. And quite frankly, like the Fed, like Chair Powell, I'd like to see the data on policy and see what tariffs really are.
So cheat sheet, when you don't want to answer, it all depends on the data. You need to be an absolute disciplined student of the data. Rick Rieder, wonderful to see you. Thank you so much for being with us, Rick Rieder of BlackRock. Coming up on Monday, don't miss this, Steve Chivarone of Federated Hermes, Henrietta Trey's of Veda Partners, Kelsey Barrow of JP Morgan, and Sarah Hunt of Alpine Saxon Woods. Also, there will be a showing from a Jonathan Farrow. Danny Berger, who has been filling in, thank you so much for being with us this week. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it, and and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
All right, we're looking at some gains here. My car makers are up. Broadcom is up. It's an exciting market on this Friday morning. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, and Bloomberg Open Interest starts right now.
The chips are up. Semiconductor shares getting a boost from Broadcom's bullish outlook on AI demand. And it's not just AI excitement. Wall Street is looking ahead to the final Fed decision of the year. We'll get the view from Morgan Stanley's top strategist, Mike Wilson. Plus, salt is back on the table, just not as much as we had before Donald Trump. His advisors considering doubling the state and local tax deduction from $10,000 to $20,000. Let's take a look at where markets are trading right now. As you saw, futures gaining about 1/3% on the S&P. We're down for the week. I think we're off about 2/3% for the week. So this won't take us to positive. It'll be the first down week in 4. The NASDAQ is doing better than the S&P as the chip stocks move higher. You can see it's up 0.75% in terms of futures. And there's not a lot of movement in the bond market. We're up 2 basis points, but now we're at 435. And just a couple of days ago, we were under 420. So
that's true. It's been a real stealth climb when it comes to the long end of the yield curve. But let's take a look at the equity market and what's moving before the bell, because Broadcom shares absolutely soaring right now. That's after they reported earnings and predicted a 65% increase in sales of AI products in the fiscal first quarter. Shares up almost 18%. Then you take a look at Affirm, just some breaking news now about a deal with 6th Street worth $4 billion of consumer loans. That's its largest capital commitment to date. That's worth about 5.5% higher on Affirm Holdings. And then you take a look at RH. This is a really interesting one. RH raising its 2025 revenue forecast, also saying that potential tariffs won't have a negative impact on margins. We've certainly heard something different from other companies in that space. So RH up about 13%. That's the micro. Let's talk about the macro and wander back over to the desk right now, because you think about the year ahead. I loved this note from Chris Harvey over at Wells Fargo, Matt, basically talking about how there's a lot of shy bulls out there that just want to be contrarian right now.
Well, and we have a tear from his note. He says, our post-2025 outlook discussions imply there are many shy bulls. Some PMs claim to be bearish, but are driven more by the desire to be contrarian than by fundamentals.
I can sympathize with that.
Well, the thing is, he says some PMs claim to be bearish.
Yeah.
But they haven't been coming on this show.
There's some quote out there. The sentiment has been said many times before that you say bearish things to sound smart. They always sound smart, but then you take a look in the grand fullness of time, it just feels like stocks always go up. So you can sound smart, but you can also be wrong.
I mean, in the grand scale of time, stocks do go up. The problem is what happens next year or in 5 years. Joining us here at the table is Morgan Stanley Chief U.S. Equity Strategist Mike Wilson. You know, people think of you as a bear also, Mike.
And also very smart, so.
But you're not really bearish this market, are you?
Well, no, we haven't been for the better part of 6 or 8 months. We took our targets up significantly in May, sort of in the idea that we were going to kind of make it through. There wasn't going to be a growth scare that caused a hard landing. And also the Fed, the Fed moved 50 basis points. And then, of course, we had the election outcome. So, we've had a lot of good things that have happened over the course of the last 3 or 4 months. So I would argue the markets have traded that really, really well as they typically get ahead of those things. The question now, and I think we said on this program in October, we said we think we could trade 6,100 on a definitive election outcome, and we got that. So now here we are, 6,100. Do we just revise our numbers higher? No, we think we're on track for 6,500 by end of next year, assuming that things progress the way that we expect, meaning the base case assumptions we have for our economic forecast for the Fed That's where the visibility, that's where the sort of risk is that our forecast on the outcome is not what we expect it to be. And I think this year's next 12 months is going to be just like the last 12 months, where there's uncertainty at times around the growth outcome and the inflation outcome. And
but up 30%.
Well, not up 30, but I mean, the thing is, the last 12 months, we got the earnings forecast exactly right. What we got underestimated was the multiple. And I don't think I was alone in that. I don't recall anyone telling me we were going to trade 22 or 23 times. But then when we get there, everyone just justifies it and says it's okay. We can stay here or even go higher. So look, markets are a little bit diabolical. They trade ahead. And when you're trading the stock market or stocks, you need to think about what's going to be happening in 6 months, not what's happening today. And I think the first half of next year is where the uncertainty probably is going to increase. And then by the second half of next year, things could clear. So it's going to be another, I think, volatile year, plenty of trading opportunity, plenty of dispersion in the stock market. That's what we kind of focus on, what to own, not how much to own. And that's the game. That's the game that we play.
Well, let's talk through some of that volatility, because there's the absolute level, right? 6,500, year-end 2025. It feels like a lot of Wall Street has coalesced around that number. But what does the path to get there look like? What do you see the road being over the next 12 months? So
that assumes that the economy stays sort of, below trend growth, but healthy, sort of 2% real. Inflation continues to climb down, but not, go in a way where it's deflationary. So you have 4.5% nominal GDP growth, which gets you 10% earnings growth. There'll be some operating leverage, and then the multiple comes down a little bit, but not as much as what we would have thought this year. Because look, that's where we are. It's very hard to get the multiple to come down if the Fed's cutting rates and you have above trend earnings growth. And that's what we're forecasting. Once again, assuming soft landing, okay, inflation continues to come down and the Fed can cut. I would say the biggest risk in that outcome is on the inflation side. We're seeing inflation pick up again because, look, let's be honest, financial conditions are very loose again. Some of that's the market itself. We have now animal spirits picking up because of the election outcome, and people are excited. That excitement has a negative consequence, which is that all of a sudden inflation starts to pick up again, and maybe the Fed can't cut. That, to me, is probably the biggest risk to the multiple.
That the Fed can't cut.
As much as people are anticipating.
So, I mean, and this may be a driver of that, but wouldn't bad certainty on tariffs, bad certainty on mass deportations, wouldn't that be bad news for the economy and for the market?
So, I mean, that's, once again, going back to our view for next year, I think the risks are front-end loaded. We're going to get a lot of announcements. Like I would say the bad stuff comes early. The good stuff from the changeover around the administration comes later, meaning, tariffs and immigration.
But you do think we'll get certainty? Because I feel like it's going to be a little bit like Lucy holding the football, Well, Donald Trump loves to play that game. He just pulls it away every time you take a kick.
Well, look, the way policy is made is you float trial balloons, you see how the markets react, and then you're reflexive. I mean, that's how I anticipate this to go down. And every time you get one of those sort of trial balloons and then policy actually is made, you get more certainty. That doesn't mean the market's going to like it or love it. It just means we're going to get more information as we go through. I mean, he hasn't even taken office yet, So let's give it a little chance there to breathe. I would say, once again, I think that the sort of headwinds for the market are probably early policy changes. And then the good stuff, whether it's deregulation, maybe some government efficiency, maybe tax extensions or even further cuts, comes later in the year. So that's the setup for now, all subject to revision, of course, because there's a lot of other things going on as well.
Yeah, a lot of big ifs there. But I do want to talk specifically about this month. You had a really interesting note out a couple days ago talking about how usually in December you see the small caps lead. That's not what we've seen. The Russell 2000 is actually down about 3% over the past 2 weeks, and it's been big tech that's been in charge. So what is different, and do you see us reverting back to some of those historical patterns?
So I think what happened is, and this happens every year, we get the sort of small cap trade earlier and earlier every year. We also had the election. And we know from 2016's experience that we were going to get a big pop in sort of small business confidence. We since confirmed that earlier this week. That was the biggest increase we've seen in 25 years, small business confidence. So maybe the market kind of pre-traded it. I still think the second half of this month, we could see further outperformance from small caps and some cyclicals, just as you kind of mark that up into year end. And then I think you'll get a fade into January, February. That's the way historically the last 4 or 5 years is or 10 years really. You get the small cap trade now earlier, and then you actually fade it at the beginning of the year.
Here's 2 weeks of the major indexes. If you take it out to 5 years, you'll see the Russell 2000 has really underperformed, and the tech stocks, the NASDAQ, has really outperformed. Does that a pattern hold indefinitely? Is this just how it is?
Well, we've had that view for quite a while. We just finally upgraded small caps this summer to a neutral. Like, we're still neutral on that view. I think right now the market is still going to be, it's somewhat narrow. I mean,
you upgraded to a neutral.
We upgraded to a neutral.
We have a viewer writing in who wants to know, what made you change your bearish stance? What was it that made you say, okay, you know what? I'm throwing in the towel. We're bold up.
Well, I mean, the data. I mean, basically, I think it was pretty consensus a year and a half ago that the Fed's hiking regime was going to lead to a hard landing, and it never arrived. And there are a lot of it. We can go into or we wrote a long note about what was different this cycle. Now, to be clear, I don't think the risk of a hard landing has been extinguished. And we're still late cycle, which is why we're trading narrow again. We're trading, people are going for the large cap quality stocks, which is why we don't want to go full overweight on small caps or low quality. We don't think this is the part of the cycle. We're not of the view that this is going to be some big ramp in the next year, that everything's changed, right? It's still a late cycle economy. Rates are still pretty high. We have cost issues with some of the smaller businesses. Most consumers are still struggling. Okay, that's not a kind of environment where small caps or low quality stocks tend to outperform. The one last thing I'll say, though, which is I think a big thing that people misunderstand, is that most stocks, okay, not the big stocks, most stocks do better when inflation is actually accelerating. So if you go back and look at like 2020, 21, and even in 22, the average stock did better than the S&P 500 when inflation was actually accelerating.
Makes sense, though. You want to hold stocks to hedge inflation, right?
And earnings growth is better. So I do think that next year what could happen is we could have a correction in the first half of next year as perhaps inflation comes back. But that's an S&P event. And actually the average stock may not go down that much. That is an interesting kind of relative value trade that I think people who can do that should be thinking about right now.
Interesting. So maybe a little bit cautious when it comes to the benchmark, but still opportunities to find at the single stock level in that scenario. But I do want to get your thoughts on how the different asset classes are talking to each other, because the bond market has been so volatile, especially if you take a look at the long end. Feels like the stock market, maybe some enthusiasm coming out, but it doesn't necessarily seem to be rates driven. How do you see that relationship evolving in 2025, especially if that big risk comes to fruition and the Fed can't cut as much as expected?
So the rate correlation with equities has flip-flopped quite a bit. And earlier this year, it was quite negative, meaning when rates went up, it was bad for stocks. And now, really since the fall, that's why we pivoted more cyclically. Stocks are now positively correlated to rates. And we think the sweet spot for 10-year yields is 4 to 4.5%. Like in that range, stocks can actually act okay, like as rates go higher. If we get through 4.5, and if term premium starts to increase, which would be concern about inflation, then you're going to see that correlation flip again. So we're, like everybody else, we watch how markets are reacting. It's very reflexive. But we think, once again, that 4 to 4.5% range is kind of a sweet spot.
All right, Mike, it is always great to speak with you, especially on a Friday. Have a great weekend.
Friday the 13th, no less.
Very, very spooky. It's great to see you.
Thank you.
That is Mike Wilson. He is Chief U.S. Equity Strategist. Now, coming up, it is a big boom for Broadcom. Shares of the stock absolutely flying right now after delivering a bullish outlook. More details next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
We spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Let's get out of high interest. Look at what's making headlines around the world. French President Emmanuel Macron is picking Francois Bayrou to be the country's new prime minister, calling on a longstanding centrist ally to navigate a fractured political landscape that toppled the last administration. Bayrou must quickly rewrite fiscal plans with concessions to gain support from Macron's political adversaries. Investors are watching closely after months of political upheaval sparked a sell-off in French assets. And Elon Musk is trying to turn the Starbase site in Texas into a new city and officially move SpaceX's headquarters there. The company's headquarters are currently in California, but it's been building out a massive facility on the southern tip of Texas near the Mexican border. There are several steps that need to occur before Starbase can actually be created as a new city, including permission from local authorities. I feel pretty confident he can get that. Now, it's not a bird or a plane or an Iranian mothership, but officials still don't know exactly what's behind sightings of car and bus-sized drones flying over New Jersey. The drones have been spotted hovering above critical infrastructure like water reservoirs, rail stations, and police departments. The Pentagon says there's no evidence the activities are coming from a foreign entity. They really don't know what's going on. The White House says the drones are legally operated. Do they know what's going on? Some residents are taking matters into their own hands to uncover the truth. A Facebook group called New Jersey Mystery Drones has amassed nearly 32,000 members. Katie, have you seen one?
I haven't seen one. I have a ton of theories that I won't share on air, especially because we have to pivot now. We have to talk about Broadcom because the stock absolutely surging. That's after it predicted a boom in demand for its AI chips last night. The company expects the addressable market for AI components to reach $90 billion by fiscal 2027. And here with more is Mandeep Singh of Bloomberg Intelligence. I feel like there's two takeaways here. One, that AI spending is alive and well, and two, that Broadcom is a big beneficiary of that. Boy, it's Friday.
And also, when you look at where this $60 to $90 billion number is coming from, it's coming from 3 customers.
Yeah.
So when NVIDIA says they have hyperscale exposure, about 40 to 45% from hyperscale customers, in this case, Broadcom's entire revenue is coming from 3 customers, and 2 are common across Broadcom and NVIDIA. Google and Meta are common customers. So really, the other inference I would draw from this is CapEx is going up. The consensus CapEx numbers for Google, Meta, Microsoft are way too low.
can we just talk more about the fact that it is so concentrated, that customer base? Because you don't see really any worry about that in the shares. But like you say, they have some customers in common, a lot of these chip companies. And I have to imagine that some of those big tech companies who are spending all this money have thoughts about bringing this in-house.
Yeah, and this is the way to bring it in-house. So what Google is doing with TPUs is they are using Broadcom to build their next 1 million cluster. And just to put it in context, it's almost 10 times the current biggest cluster, which is 100,000. So clearly the scaling laws will continue to be applicable when it comes to AI. And a lot of these customers, I mean, Meta, it looks like they may bring it in-house if they are a big spender on Broadcom chips. Then you don't need to buy as many chips from NVIDIA. And that is the part that is still in flux because no one knows if they will continue to scale up on NVIDIA architecture or they'll build their own, which is what Google has done. And they have shown that. Amazon hinted at that. But I think now it's becoming more clearer that every hyperscaler wants to scale using their own chips.
I have looked at the stock, and it's doing better than all of the other Mag 7 stocks, with the exception of NVIDIA and Tesla. So Broadcom is up total return like 564% or something over the last 5 years. We probably have a chart that would show it perfectly. In any case, that said, $90 billion in an addressable market 2 years from now doesn't sound like very much. That's half of General Motors revenue, and they're like a 100-year-old car-making company.
Well, so it's 90 billion just from these three customers, which are currently, the addressable market from them is 15 to 20 billion. So the fact that these three customers could become 3 to 5x in terms of their spend, and look, there could be potentially Apple and OpenAI. Those could be two new customers in terms of the data center spend. But, you know, the customer base is very concentrated, and it just goes to show that, you know, Apple hasn't really spent a lot on CapEx so far on NVIDIA GPUs. Well, guess what? They may end up building their own silicon on the data center side, and they will end up using Broadcom.
Is there any urgency among these companies that you can sense to onboard new customers, to get new big sources of spend? Because you think about Broadcom in particular, I mean, forecasting sales of AI products gaining 65% just in the fiscal first quarter. I mean, is that just a single customer?
Yeah, think of, you know, TSMC's proposition. It's a foundry of the world. Everyone goes to TSMC because they are the kind of the most neutral player when it comes to manufacturing this. Broadcom could be the same way for hyperscalers. All the hyperscalers could come to Broadcom for their connectivity and their custom GPUs or their custom chips, and they don't need to rely on NVIDIA. And that's where I think their pitch is that you can customize the chip according to the workloads. I mean, the fact that AI needs 1 million clusters, it just tells you that AI is a scale problem. But you can solve that scale problem using a Broadcom, which is a neutral customer. It will never compete against the likes of Google or, you know, Microsoft or Apple that are deploying this for their applications, whereas NVIDIA could be a potential competitor down the line.
All right, Mandeep, really appreciate the breakdown, making sense of what's going on in Broadcom shares, absolutely soaring right now. That is Mandeep Singh of Bloomberg Intelligence. Let's show Broadcom pre-market once more, because the stock was already up bigly this year by more than 60%, adding another 19% pre-market, set to open at an all-time high. So AI optimism clearly alive and well, Matt.
Yeah, I mean, I think it's absolutely fascinating. And don't forget that Broadcom isn't the only potential competitor to NVIDIA. So there are a number of other smaller businesses, you know, that say they have chips, designs ready to make that are just as good. So we'll continue to focus on Broadcom for sure. Coming up in the next hour, we're going to dive more into the tech trade with DoubleLine Deputy CIO Jeff Sherman. And we're going to ask Jeff, what's the deal with those drones? Do you think he has a theory?
I don't know. He's in California.
Apparently dozens, even hundreds of drones over New Jersey that the White House says, like, please disperse. There is nothing to see here.
I bet he could come up with some great theories on the fly, but I don't think that man thinks about New Jersey. But we'll ask him. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, welcome back to Bloomberg Open Interest. A quick check on futures here. We have some green on the screen finally. If you take a look at the S&P 500, up about 0.2%, even better on big tech. The NASDAQ 100 up about 0.6%. The small caps not really feeling a lot of the love right now, down about 0.1%. It's actually been a brutal month so far for the small caps, even though seasonality tends to benefit the little guys in December. We'll see if that changes. But coming up, less than 4 minutes until the opening bell, we'll discuss the market moves and so much more with Evans May managing partner Brooke May. That conversation up next. This is Bloomberg.
The leader in technology for as long as you have been, do you think AI is just as landscape changing as everyone else seems to think it is?
Sometimes things are overhyped. I don't think that AI is overhyped.
I think Etsy's uniquely positioned to benefit from AI. Finding that needle in the haystack is tricky. That's part of what makes Etsy both delightful and frustrating to people. And being able to serve the good stuff to the top fastest is where AI can really benefit us.
Our mission is keeping commerce human, and actually we talk about AI as helping us to be superhuman. It's really the partnership between AI and humans that makes Etsy work.
AI can help Etsy's customers personalize their searches and steer shoppers more directly to items they may want to buy. It's also helped the company improve reliability by predicting delivery times more precisely. But that doesn't solve a larger challenge, getting more consumers to think of Etsy more often and ultimately become repeat buyers. To this end, Etsy invented gift mode.
getting in the top of mind consideration when you're thinking, I have a gift, I'm going to go to Etsy, just getting that to be more habitual. Gift mode provides a perfect opportunity for that. We get to know the gifter, but we also get to know the recipient. So it's a way to, sort of a more viral way to bring in more, introduce more people to Etsy.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Futures are higher, at least for the big guys. Moments away until the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. You can see that we're looking at gains on S&P futures, gains on NASDAQ futures. Russell 2000 futures are down, and they've had a rough month thus far, although as Katie and Mike Wilson point out, seasonality is good for the Russell in December. You hear the opening bell ringing down the New York Stock Exchange. Timken, they're apparently innovating for tomorrow, and C.H. Robinson down at the NASDAQ market site. Now, it is still set to be a down week, and if we don't move up much higher, it'll be the first losing week in 4, but maybe we can get there by the end of the session. Katie Greifeld, what does it look like right now?
It's certainly possible. A lot can happen between 9:30 and 4 p.m. as we learn every single day, and you take a look at this setup right now on this Friday the 13th. You can see the S&P 500 currently up about 0.3%. Like Matt said, heading into today, the S&P 500 is down about 0.6% for the week. That would be the first down week in several, so we'll see what happens. Big tech currently in charge. The NASDAQ 100 up about 0.9%. We know Broadcom popping off right now has to be lifting that benchmark. The small caps, they had a rough day yesterday. They're having a not so nice day today. We already flipped up, but the Russell 2000 down about 0.2% right now. Now we'll get to Broadcom. Of course, you can see that shares are soaring right now, chasing all-time highs. It reported earnings last night, anticipating sales of AI products to jump 65% in the first quarter alone. AI revenue also grew 220% during the year. So you add it all together, shares are soaring. This is now a $1 trillion company. We're also keeping an eye on shares of Affirm because shares soaring after inking a deal worth $4 billion in consumer loans with 6th Street. That puts Affirm's loan originations over the next 3 years at over $20 billion. That's good for the stock because shares currently up about 4.6%, Matt.
All right, all interesting stuff, but we've really been focused on furniture this morning. Restoration Hardware is surging to the highest level in almost 3 years. It raised its 2025 outlook, saying tariffs would not negatively impact margins if implemented. And we want to take a closer look at the whole group, as well as RH with Bloomberg's Abigail Doolittle. Abby, what do you got?
Well, Matt, let's really dig in on RH first, because it was a great quarter that they put up. They swung to a profit for November. The RH brand in particular, the demand was up 24%. Right now, December tracking up 30%. So some real strength there. And as you mentioned, they boosted the view. They're now looking at sales of up 6.8% to 7.2%, better than what had been. So the strength that they've been seeing in November and December, they think that it is going to play out for the rest of this year, although the fiscal year 2025 for them does end relatively soon. But nonetheless, investors loving this. The stock up 30% on the year. This is pretty in line, though, and I should say into today's big boom with the rest of the retail space. What we're looking at here is the S&P 500 Consumer Discretionary Index in white up about 36%, and then staples this year up about 35%. The best year, up 17%. The best year since 2019. So really some consumer strength there. The S&P 500 right in the middle, up more than 25% strength any way you slice and dice it. But Katie, we of course have this bifurcated consumer, and it's really interesting because RH, of course, is a super high-end furniture, but so does Ethan Allen. Take a look at RH on the year now with today's gain up close to 55%, whereas Ethan Allen down on the year. RH booming along. Ethan Allen has had a couple of misses. They both have pretty high short interest, but it seems like those bears are winning just a little bit more on Ethan Allen. RH, one of today's big winners, and on the year, too.
All right, Abigail Doolittle, thank you so much. I think
no mention of Lovesac.
I knew
no
that
mention of Wayfair.
We all knew you were going there.
Yeah.
So, but yeah, it is interesting because Wayfair, I think they're doing a little bit better Oh, no, actually, they're doing terribly for the year. And you compare that to RH. And like Abigail was saying, it's really hard to talk about the consumer as a monolith right now. Everything feels so company-specific, so C-suite specific, that it's hard to really paint with a broad brush when it comes to some of these names that are even within the same sector. But
I'm just pulling up the comp screen. You know I like a solid 5-year period, and Wayfair is down 40% over the past 5 years, whereas Restoration Hardware has doubled. I will reiterate Lovesac, though, because I absolutely
even though it's a tiny company.
I know it's a small company, but it's a hilarious name, and the stock has done really well, better than those other two, up 133%. It had a tough day yesterday. It fell like 24% after a bad outlook, but they make giant couches that are a little bit too extravagant for my wife's taste, and they have built-in subwoofers.
That's nice. Do they have, like, you know, I can really put my drink down and
if you put your drink down, it'll charge.
Okay, great.
Wirelessly.
Beautiful. Yeah. There we go. There's the 5-year look. 130% or so. Matt, of course, is all bold up there. Let's broaden out this conversation now with Evans May Wealth Managing Partner Brooke May. And Brooke, I want to come to you on the consumer, the conversation we were just having. I won't ask you about Lovesac specifically, but you look even within a single sector, a single industry, and there's big dispersion at this point in the year. What do you make of that when you're trying to evaluate this market?
It makes it difficult. And as we know, the S&P 500 is predominantly driven by the top 7 names. And so whenever we talk about the direction of the index, it's going to really lead with big tech and AI. However, there is a dispersion right now between earnings, and all companies aren't created equally. So you really have to look at where the earnings growth is, specific not just to industries, but also to individual companies.
So, you know, we were told that the consumer was waiting, that businesses were waiting for the election for certainty on purchases and orders, but we still don't really have that, right, Brooke? Because even if I look at something as seemingly silly as the furniture makers, tariffs really matter, and we need to know what they're going to be before we buy those stocks for next year.
We couldn't agree more. When we look right now at the Fed, there's a 96% probability that they're going to cut rates next week, but we fully expect them to pause in January. And we think that pause is going to be also correlated to the fact that they're going to wait and see what the Trump administration wants to do and if those policies are inflationary. It's scary, 60% tariffs on Chinese goods. When we look at the U.S. economy, we're very dependent on those imports. And during the first term, a lot of those increases in tariffs were absorbed by the manufacturers. And that won't happen this time around, at least not to the full extent. So I think that the Fed will partially pause just to see if tariffs are implemented or whether we're going to see just some symbolic tariffs and then some negotiation after that.
I want to dial in on the Fed here. Of course, we're counting down to their meeting next week. We were just having a conversation with Mike Wilson, who said one of the biggest risks for 2025 is that the Fed can't deliver the rate cuts that the market is expecting. And if we do get that pause starting in January, do you think that the market is prepared for it at this point?
The market has done very well, clearly, and we're optimistic going into next year. Our price target is in line with Mike Wilson's at 6,500. That said, you know, we think that there's really quite a bit that can happen between now and then. And so we're going to just wait and see what the data has in store for us and then go from there.
What about alternatives to stocks? Is there any, is there any alternative to U.S. stocks? Do you like other regions?
We don't. You know, right now internationally is trading at a discount, but it always trades at a discount. And we feel like that discount is warranted. We think that the best risk to return right now. At some point, this discount,
Brooke, must get too deep, right? At some point, EM falls off so much that it's too cheap to ignore.
We still think it's the best risk to return. You know, yes, you can make money in EM, but there's a lot of factors at play right now. Tariffs, for example, in addition to other factors. And so we continue to like US. We're equity biased. Most of our portfolios are equities. We don't use a lot of alternatives because we think that over time, that's where you're going to make the most money. And right now, we're overweight significantly to the US.
That's interesting. I mean, is there anything that would change that setup from you, either when it comes to the U.S. side of things or maybe the rest of the world side of things?
Absolutely, absolutely. If we were to see some bifurcation and the U.S. started to struggle, however, foreign markets were doing better and foreign economies were doing better, we absolutely would shift. But right now, we think that the U.S. is the best game in town.
We have the Fed next week, Brooke, and of course, we're dialing back our expectations for the cuts in 2025. I think everyone's on board that there will be a cut December 18th. But how important is the Fed to this market? Is it taking a back seat to things like economic growth, to things like tariffs?
We're at a point now where rates aren't necessarily crippling. And whenever we look at other factors at play, we think that really CEO sentiment right now is a factor that we're focusing on more than usual. And when we looked pre-election, CEO sentiment was stable, but not overly optimistic. And we think the next read, there's going to be a shift to more optimism. And CEOs are the ones making the decisions on hiring, firing, and also spending from a corporate standpoint. And there's a lot to feel good about right now if you're a business. We likely will see lower corporate tax rates. We're going to see probably some deregulation. And we've seen hiring conditions improve. So all that, in addition to spending, right now we think that businesses are going to increase their spending on CapEx and R&D, maybe 7 to 8% next year. We expect share buyback spending to be up 20% and dividend spending to be up about 7%. That's a good environment to be an investor.
Brooke, great to get some time with you. Hopefully we get you here in the office soon. Brooke May there, Evans May Wealth Managing Partner. Coming up, we're going to take a look at which cars revved our engines in 2024. I did not write that pun.
Are you sure?
But I read it. And which got stuck on the side of the road. Hannah Elliott joins us from the podcast Hot Pursuit. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements. And TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers
is
you're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, two paws up for General Mills. The food giant is getting upgraded to a buy over at Bank of America. The firm expects General Mills to return to growth at a faster rate thanks to a re-acceleration in pet food demand. Next up, we have JP Morgan cutting its outlook on home builders. The firm downgrading D.R. Horton to a sell. The analyst sees a much less supportive demand and supply backdrop for the industry and expects that D.R. Horton will underperform over the next year because of its expensive valuation. JP Morgan also cutting Toll Brothers and Meritage Homes. And finally, Goldman Sachs is initiating coverage of e.l.f. Beauty with a buy rating. The firm sees growth potential thanks to the company's innovation and its convergence with the health and wellness industry. The analyst says, quote, e.l.f. is one of the most disruptive players in beauty. Matt Miller.
Yeah, I have felt the same way ever since. Actually, one time I talked to a woman who was driving a car for e.l.f., and I thought it was e.l.f. Aquitaine.
Interesting.
At the Indy 500, and it was actually Eyes, Lips, Face.
What a nice segue.
Yeah. Yeah, it is a good segue into the auto industry. It's been a hectic year for a lot of the car makers across the globe. They had to make adjustments due to economic and geopolitical volatility. Plus, they spent all this money investing in EVs, and now nobody wants an EV. But we saw manual transmissions make a resurgence, thank God. And here to talk about the year that was is Bloomberg's Hannah Elliott. She is my co-host on the podcast Hot Pursuit, and also a lover of, well, you like more luxurious, more expensive cars than I do.
Sure, I've been accused of being a snob, but I'll take it.
So,
I've been called worse.
So you have a list out of your best cars of the year, and you've had amazing driving experiences, climbing up a mountain in an off-road Porsche and driving around Villa d'Este or whatever you call it in Italy in very expensive collector cars. What was the best experience for you this year?
Well, this may or may not surprise you, but my favorite car that I drove was the Ferrari 12 Cilindri, which is Italian 12-cylinder. And I love this car because it's really polarizing. It is kind of a throwback to early Ferraris, like you might see a little bit of a Ferrari Daytona in the front, but it has a 12-cylinder engine, which is increasingly rare, but it's still really noticeably, obviously a Ferrari. It just drives amazing, a top speed of 211 miles per hour, more than 800 horsepower. A good combination inside of, there are some really advanced screens, but there are also some buttons and knobs that I still like to be able to work when I'm inside. So a really nice combination of everything.
And an interesting tactile experience, it sounds like.
Exactly, which is key. I personally, I love a screen, but I also want buttons and knobs, and the 12-cylinder Ferrari really combined all of those nice things.
So I can't relate to either of you because I haven't touched a lot of these cars and probably never will. But
you have a good car.
I do have a good car. I drive a Genesis.
Cool.
Yeah,
GV70.
GV70.
Amazing.
Got very good reviews.
Yeah, it's pretty nice. I love the grill. But I also do love trucks, and you also have a truck on this list. So let's talk about it.
Yeah. So this Ford F-250 King Ranch, it's about $75,000, which is actually pretty affordable for some of the bigger, nice trucks. I mean, usually they're over $100,000.
And it's the diesel, right?
And it's the diesel, which, again, I love. And maybe we're sounding a little bit old world in this age of EVs. I'm talking about a 12-cylinder and a diesel engine. But I just love it. It's completely functional. It can tow more than 40,000 pounds, but inside feels really luxurious. It's got all of this cool King Ranch stitching. King Ranch, as you know, is an actual ranch. It's a place. And I just kind of like great visibility, very comfortable, rugged, but it's got some nice touches for those of us who like the finer things in life.
And over 1,000 pound-feet of torque.
That's, yeah, I mean,
that sounds like a lot.
It'll hammer down. I mean, even Matt would love that truck.
I definitely do. I want to show you a couple charts.
Please.
First off is Ferrari versus the rest of the luxury manufacturers, or what I would put in there. So I put Volkswagen because, you know, they own Lamborghini and Porsche. Well, Porsche is its own stock now, and that's what I want to ask about. But we put Mercedes and BMW. Ferrari is doing the best of all of these since Porsche started trading. Porsche's doing the worst. And this company has some of the most amazing margins of any car maker in history.
Yes.
And it makes cars that we all love and want.
Yes.
What's the problem?
Porsche is at a really interesting time. It has had a decade of dominance and now is going through a real sort of maybe philosophical struggle about where it's headed with electric vehicles. And I think that is causing a ripple effect throughout the rest of the company. Let's not forget EVs have really been a challenge for VW, which still owns Porsche, controls Porsche in a way. And that is affecting a lot of Porsche's production, delivery discipline. It's having a ripple effect, and I think maybe that's what we're seeing in this chart. Ferrari has not felt in the same way, and let's talk. I mean, Ferrari has far smaller volume, so it's a different animal,
and even higher margins.
Completely.
By the way, we were showing the company video of the presentation for the GT which Hannah drove in, I believe, somewhere exotic in Spain.
Yes.
And it had like a hybrid turbocharger and gearbox. It's all very complicated.
Sounds very fancy and complicated.
It's fancy, and it's interesting that Porsche is really trying to hold back the 911 from going fully electric. The hybrid's a concession, but no full EV yet for the 911.
All right. It's unfortunately all that we have time for.
I know. We didn't even get to ask about what you hated, but we'll have to have you back.
But I'll tell you what, the good news there is we actually made a podcast episode about that.
Yeah.
So, you know, you should come on and talk about your Genesis.
I have some things to say. I don't know.
We'd love to hear. If you have pet peeves, I love a good pet peeve.
She has electric truck experience.
I do.
So she's driven.
Not the Cybertruck. I'm a little bit obsessed with it. I feel like maybe you don't like it.
No, it was actually better than I thought it was. That's another thing that I drove this year. I actually loved that little kids come up to that truck and love it.
Yeah.
You know, anything that gets people excited.
Like a child drew it, and then it became a real life truck. So that makes sense that they would like it.
And it also reminds me a little bit of the DeLorean from the 80s, you know, from Back to the Future. It's got that same stainless steel, flat lines. There's something that it's nice when cars make people feel something. Yeah. Maybe they make you feel hatred.
Yeah.
But, you know, at least they have some sort of emotional response.
It makes me feel mirth and joy. It also looks like it would get very hot in the sun, but why don't you promo your podcast?
I will promo. Well, first I'll say Tesla hit an all-time high in terms of its stock just a couple of days ago. And you should check out our podcast. It's called Hot Pursuit. I host it with Hannah Elliott every week. A new episode coming out today with McKeel Haggerty. Now, coming up, Trump vowed to bring back the state and local tax deduction, or remove the cap is what I should say. And now they're talking about going halfway. Is it his first broken promise? That's next in our Wall Street Beat. This is Bloomberg.
Fixed Income Fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Is the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Time now for the Wall Street Beat. Donald Trump plans to bring back some of the state and local tax deduction. His economic advisors are considering doubling the deduction limit from $10,000 to $20,000, but still capping it. Now, you used to be able to write off your state and local taxes from your federal. That was just how the system worked until 2017 when Trump and the Republicans capped it at $10,000. Then, campaigning this year, Donald Trump came to Long Island and said he would bring SALT back. It doesn't look like they're really going to do it. Bloomberg's Stephanie Lai covers the Trump transition and joins us now. So, Stephanie, I think the president led everyone in New York to believe that he was going to bring the SALT deduction back, and now they're going to go a little bit of the way, but not really do it. Why?
Well, when we look back at his Truth Social, where he announced that he wanted to bring SALT back, that's really all he said. You know, he never really specified with any real specificity in terms of what that would mean. And so when I was speaking with some economic advisors, they had said that, you know, what they're considering right now is a partial, an increase to double it. And part of that is because in order to enact his tax agenda, there's going to be a lot of offsets needed. And if we were to get rid of SALT entirely, that would lead to a massive increase in what we need to find extra money for to make up for this lost revenue.
Do you expect anyone in Congress to fight them on this? Because the idea was to go back to the way it was before he put a cap on SALT, which was that everyone could write off state and local tax deductions.
You know, even if it's not an entire change to the system, it is sort of a step forward for some of these vulnerable Republicans and also for Democrats who wanted to see change. Doubling the cap enables middle-class families to write off more of their taxes. And so with this slim majority in the House, it does seem like this could move the ball in a way.
All right, Stephanie, an ongoing conversation. I'm sure we'll have you back soon. That is Stephanie Lai. Now, coming up in the next hour, Maddie Desner from Capital Group, as well as Jeff Sherman of DoubleLine. All that and more coming up. This is Bloomberg.
My name is Konstantin Stefana. I'm the owner of the family office and the company called Company I Limited. I also have a live streaming channel for startups. It's SG Trader, so we let startups to pitch investment community on our channel. I give them 3-minute pitch. We publish their video on our channel, and everybody who is interested, please welcome to send me your video, and I will roll for almost a month your video for all financial community. The channel is live. It's streaming live 5 days a week, from morning till night.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. We begin with growing concerns over drone sightings that have now spread from New Jersey to New York and Pennsylvania. Correspondent Tom Hansen.
The drones have flown precariously close to critical infrastructure and sensitive military sites, like Picatinny Arsenal, which provides munitions products to all branches of the U.S. military. But the White House says,
we have no evidence at this time that the reported drone sightings pose a national security or a public safety threat.
And the drone unit we met says these are sophisticated drones with a wingspan up to 8 feet. These drones can also travel much faster than the ones local authorities deploy, and even when they have gotten close enough to snap an image, the mysterious objects go dark.
Snow and bone-chilling cold are making things miserable in parts of the Midwest and Northeast. Meteorologist Jim Cantori at the Weather Channel.
This is our third major lake effect event. We've had over 100 inches in many spots. Now we're into the deep freeze, just like behind the other two. But as we get into this weekend, we will slowly warm from south to north. Not before squeezing out a little ice storm, by the way, tonight across parts of Iowa and northern Missouri.
Yesterday, we told you about Alex Timmerman, the man from tiny Urbana, Missouri, who was freed from prison in Syria 7 months after he walked into the country on a spiritual journey. While others go free, ISIS fighters are still locked up. CBS's Holly Williams has returned to a prison she visited in 2019.
The inmates joined the so-called Islamic State from all over the world. Now they're locked up, apparently indefinitely, 20 or more to a cell. This man told us he was a doctor from Windsor, Canada, who travelled to the Islamic State and was captured 6 years ago.
We all make mistakes, right?
To the Canadian government, do you have a message?
Why haven't they come? Why haven't they asked about me?
Here in the U.S., new signs lower income earners are scrimping to get by. Here's CBS's Stacey Lynn.
The Wall Street Journal reports that dollar stores are seeing the struggle the most with their core customers. They say they're waiting to shop for things until the last minute, and they're spending less towards the end of the month when their budgets are depleted. But they say there is one area where they're doing well. Store brand products are selling, with some stores like Dollar General saying their Value Valley aisle, which offers all items for $1, was its top performing category in the last quarter.
You know it's Christmas time when the tubas are tuned up and ready to go at the Kennedy Center. The very first tuba Christmas was held at the skating rink at New York's Rockefeller Center in 1974. This is CBS News.
IncomeTaxRelief.com.
A Florida mother was arrested after police say she threatened a health insurance company.
Authorities say 42-year-old Brianna Boston used some of the same words found on shell casings in the United Healthcare CEO's murder. At the end of a recorded call to Blue Cross Blue Shield, Boston is alleged to have said, "Delay, deny, depose. You people are next." An arrest affidavit says when confronted by Lakeland, Florida police, Boston apologized and said she used those words because they were in the news. Steve Kathan, CBS News.
He plays a mean draw. But U2's Larry Mullen Jr. says he's always had a hard time with math, and now he's found out why. He tells Times Radio he's been diagnosed with dyscalculia. He says it's a learning disability that makes it difficult to understand numbers and arithmetic. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well as head to youtube.com and search Bloomberg Podcast. That's where you will find us. Coming up today, Alan Katz, Bloomberg Powers Bureau Chief. He's going to give us the latest on what's happening over there in the political front over there in Paris. We got some changes to the Prime Minister role. We'll get the latest there. Miguel Sosa, head of market research and strategy at Blue Rock, will discuss his thoughts on the markets. Katerina Sarajeva, Bloomberg Federal Reserve reporter on the Fed to cut once more before potentially slowing the case in 2025. That's according to a lot of economists out there. Jody Lurie, Bloomberg Intelligence credit analyst. Here, how about this? 72% of vacationers aim to boost 2025 travel spending. How about that? I'm all in on that. I think we're going to Italy in the fall.
Oh, you are?
How about that?
Wait, so when's the cruise?
Well, we're not sure about the cruise.
I thought you booked the cruise.
That might have gotten deferred a year.
Oh, interesting.
So we're seeing. We're going to meet Saturday with our travel person.
And
we have a travel person.
Oh, he's a travel person.
We have a travel
He's so old school, this guy.
Exactly.
Although probably gets a good deal.
All right, so there's a lot coming up here. Let's check in here first with Mr. John Tucker and get a Bloomberg Business Flash, John.
And this Bloomberg Business Flash being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around the clock. Well, it's a rally in Broadcom that's pushing gains across the entire chip technology complex. The NASDAQ 100 climbing right now. It is up to another record, up 206 points right now, 21,822 shares of Broadcom. They are up 21% at this point, a record after predicting a boom in demand for its artificial intelligence chip and reaching $1 trillion in market value. The peers, Marvell Technology, Micron Technology, NVIDIA also rising. Meantime, John Stolfitz at Oppenheimer is among the most bullish on Wall Street with a 2025 year-end target for the S&P 500 of 7,100.
Fundamentals are intact. You've got a business-friendly administration coming into the White House, as well as, at least on a marginal basis, Congress, is essentially more business-friendly outlook, it would seem.
Stock market's also likely to benefit from the interest rate cut we expect next week. The Fed priced to deliver a quarter-point reduction. Again, the S&P 500, 8 points higher. That's up 0.1%, 6,059 on the index. The Dow, 30 points lower right now. And the NASDAQ 100 up 189 points. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. We knew this once, but why is the ticker symbol for Broadcom AVGO? I don't remember.
Great question.
I think it happened, didn't they like change businesses or something? Or we're going to find this out.
We're going to talk to the BI dude on this later on.
I'm not smart enough to
I'm going to use the Google. And we're going to figure this out. But in the meantime, let's get to Market Drivers. Market Drivers is brought to you by JP Morgan Asset Management. Stay informed on today's fastest growing investment vehicle with the new guide to ETFs. Visit jpmorgan.com/ETF Insights to learn more. And let's get right to it with Emily Grafeo. She joins us now. So let's start off with Broadcom while I Google the company change thing.
Yeah, I'm looking forward to learning what that ticker means. I literally had to refresh my SINS page on the terminal this morning, SINS, because I could not
Which, by the way,
believe.
is an internal function only.
Really?
Yes.
Oh,
Just
so it's
letting
not
you
even worth plugging it.
So never mind.
Radio.
It's a really cool function that we
Well,
get to see how much the
why
stock
it
has
isn't.
been up on a weekly, daily, monthly, yearly
Right.
basis. So when we say all these cool Bloomberg stats, like the S&P is up X amount, the longest run since 2007, that's where we get it.
And that's what I did for Broadcom. And I was shocked to see that it's at a record high, biggest intraday gain since 2020. And like John Tucker was just saying, all about the sales of its AI products. They predicted it's going to gain 65% in the fiscal first quarter, which is actually faster than its overall semiconductor growth. So they're a chip supplier for Apple. They make AI chips, but they also make other kinds of chips that I guess don't power AI processes. And today, it's all about the growth in their AI
Market cap
chips.
$1 trillion. So another $1 trillion company driven by, in large part, AI.
But here they're actually delivering it.
Okay, good point.
wait a
At
second.
least in
Was
terms of numbers, but
Avago Technologies took the Broadcom, part of Broadcom Corporation name after acquiring it in 2016.
You stole my Wikipedia blurb on
I
that.
can look it up.
See, I knew it was some kind of mergery thing.
Avago Technologies.
But now they have to deliver, right? So it's going to be that they have to beat and raise. We're going to be back into that sort of situation, but at least they have the numbers in some ways to back them up. What about RH?
And their AI revenue grew 220%.
That's not nothing.
Year
Yeah.
over year. So I think that's what investors are really focusing on today. RH, Restoration Hardware, very fancy.
Alex does not shop there, I don't think.
I don't
Because
shop
it's so
there.
fancy.
Yeah,
So
I'm sure
fancy,
you
expensive.
do, Paul Sweeney.
Well, back in the day,
A
yeah.
discounted rug is like
I have
$5 grand,
I have
please.
people who do that. I don't know where it comes from. I have
Yeah,
people.
it's fair. Yeah.
It's been hard for a lot of luxury retailers this year, but Restoration Hardware
Does
up
very well.
over 50% year to date, and today up as much as 19%, the highest level in over 2 years. They had pretty good earnings. They raised their revenue forecast for 2025. They now see revenue up 6.8% to 7.2%, and then they swung to a profit in the third quarter. So year over year, looking at a loss per share of 42 cents, but for the third quarter, adjusted EPS came in at $2.48.
And stock at a 52-week high, not an all-time high. That was achieved back in 2021 when people were going crazy buying furniture during the pandemic, but a 52-week high nonetheless, so good for them. What else?
I'm also looking at Trafigura. So this is not a publicly traded company or a stock, but it's one of the top stories on the Bloomberg terminal today because this is one of the world's largest commodity trading shops. And Bloomberg has reported on some of the employee misconduct that they had in their Mongolia oil business for a while. But anyway, today we got news that they reported a 62% drop in profit. They took $1.1 billion in losses. And again, this is all related to alleged employee misconduct in that oil business. So this is from a Bloomberg report back in October, but the company found that some of its employees in Mongolia had manipulated data and documents to inflate the amount of money it paid out. Now, they reported this net profit down 62% from the previous year, but it was only the lowest in 4 years. So, I mean, they had a big boom when commodity trading post-pandemic kind of exploded, but...
And we're talking like Gunvor, Trafigura, Glencore, like these are the commodity players, traders. They know where all the stuff is moving. They're the big guys.
Mongolia, fraud, I'm shocked.
I mean, yeah, they've also been cleaning a lot of house in terms of bribery allegations. In general, the traders have been sort of up against this in different areas of the world. All right, thanks so much, Emily Grafeo. We really appreciate it for Bloomberg Market Drivers. All right, let's get to overseas. We're going to France. President Emmanuel Macron appointing François Bayrou as France's new prime minister to navigate a fractured, I feel like that's a nice way of saying it, political landscape. And there's a to-do list that's very difficult. Alan Katz, as Bloomberg Paris bureau chief, joins us now. Alan, does he have to get like approved or voted for, or is he just in power and then he's going to make it work?
So the latter, he's just in power and he has to make it work. In France, the president gets to nominate whoever he wants as prime minister. So great. So now you've got François Bayrou, but he has to get a few things done. Most importantly is the 2025 budget, and that's what caused his predecessor, a guy named Michel Barnier, to get booted out in a no-confidence vote last week. So that's going to be his first order. Well, his first order of business really is getting a cabinet together, getting a government together, and then it's going to be trying to get a 2025 budget passed. So that's really the first things he's got to start to do, and it's not going to be easy.
So, Alan, is there any reason to believe that this new prime minister will have any better luck with the right and the left, which caused the demise of the predecessor?
So that's a good question. I guess the best answer is maybe. He's a centrist, right? So he has been known to do. I mean, originally, sort of his party was more aligned with the sort of the center right back in the 80s and the 90s. But then he famously voted for a socialist for president in 2007 rather than the conservative guy. So he's reached out to both sides over time. He also was very famous for having supported Marine Le Pen's right to run for president in 2002. In France, you have to get 500 signatures from local officials to be able to run for president. And he said, well, she's very popular. We can't not have her run. That would be really bad for democracy. I don't support her personally, but I support her right to run. And the far right remembers that. So he's got sort of possibilities, but then really getting people on side is going to be much more difficult. Michel Barnier, the guy, again, who just got ousted, he sort of had the far right on side for a while also until they weren't. So far, everyone today has been giving, I guess, sort of mildly positive comments. They're going to say, we'll wait and see, or it depends on what he presents. But it's really not clear that he's necessarily going to have any better luck than Michel Barnier did.
What does the far right and the far left want?
Very different things. But mostly what they want is someone who's going to allow them to look good to their voters as they get toward the 2027 presidential election. That's one of the problems that we have in France right now, which is that you have this big bloc on the left and a big bloc on the right. On the right, it's led by a woman named Marine Le Pen, who's the most popular politician in many polls in France. And certainly the person who leads polls if the next presidential election was to happen today. The person who's frequently number two, or if not number two, number three, is the guy on the far left named Jean-Luc Mélenchon. And the two of them are definitely looking to the next presidential election. So all of their decisions in the short term, in terms of what happens in Parliament, passing a budget or any other laws, is all about what does this mean for how voters are going to perceive me in 2027. And that makes for a very difficult relationship, because sometimes there are things that you might say, well, that's obvious, sure, they should like this, but then they don't. In the case of Michel Barnier, he basically gave in to most of the far right's demands, basically 3 out of 4 main ones that they had, and they voted, they voted for a motion of no confidence anyway, because they decided it was in their interest, in their longer-term interest to do so. So that makes it really quite difficult.
Alan, thank you so much. Appreciate your reporting. Alan Katz, Paris Bureau Chief for Bloomberg News. How cool is it that we get people on the ground, really smart voices, pretty much everywhere around the world, and they come on the air with us?
Very cool.
That is such a great
and they really know what they're talking
advantage,
about.
and they know exactly what they're talking about. I want to ask about next time we talk to Alan, how big of a story is it in Paris and France, the reopening of the Notre Dame? Because when you saw the damage from that fire 5 years, I'm like, they're never going to fix that stuff.
Yeah.
I mean, how do you fix that?
I mean, we went to Paris last summer, and it was like, it's never going to... They're going to be so behind, and then they did it. I would think that culturally, and the message it sends is pretty spectacular.
I mean, I give Macron a pat on the back, and the French people a pat on the back, because that was awesome. How they.
But remember,
so I want to go over
egg prices and fuel prices.
Egg prices and fuel prices. I get it. So we'll have more on that coming up. S&P up 12. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We are being brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. Right now, only two of the major industry groups in the S&P 500 are higher, but that's enough, being led higher right now by information technology. It is Broadcom that is surging right now, up 23 points. That's enough for a record after the company beat Wall Street profit targets and delivered a glowing forecast, highlighting, among other things, its artificial intelligence products. Broadcom shares right now, again, 23% higher at $221.36 a share. This is enough to push the NASDAQ 100 to another record, up close to 1%, 21,822 on the index. The S&P 500 just 8 points higher. That's up 0.1% at 6,059. And the Dow Jones Industrial Average, it is lower, 37 points lower, down about 0.1%. RH, formerly known as Restoration Hardware, climbing despite missing Wall Street sales and profit forecast. RH shares up over 14%. The furniture and housewares chain telling investors it expects strong demand to continue despite a housing market that's mired in a years-long slump. As far as the yield space, 2-year yields right now up 2 basis points, 4.21. The 10-year right now up 3 basis points. That is at 4.36. And remember, a Fed meeting next week, pretty much priced in a 25 basis point cut. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right. Thanks so much, JT. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We're broadcasting to you live from our interactive broker studio right here in Midtown Manhattan. All right, so we get the Fed on Wednesday. Highly expect to cut rates in December. The question then becomes what happens in 2025 if that neutral rate is moving up, as Bill Dudley, former Fed governor, was talking about on surveillance. If he thinks the neutral rate is 3.5 or a little bit higher, what does that mean then for the trajectory of cuts? And then what does it mean for sectors that are really waiting for those cuts to kick in, like real estate, maybe private markets, private equity? We want to delve a little bit deeper into this with Miguel Sosa, head of market research and strategy over at Blue Rock. He joins us now from Dallas, Texas. Before we get into the nitty-gritty of, say, private credit and real estate, just give us your broad views on 2025.
Yes, thank you, Alex. So we're excited about 2025. We think that the markets are poised to perform well. We've seen strong performance for 2024 with a change in administration. We think that the administration is very business friendly, so that should provide an additional tailwind, in addition to having the high interest rate environment behind us. And so what we're seeing is gradually moderating interest rates, a predictable and shallow decrease in that interest rate curve on the short end, stable in the 10-year side of the interest rate curve, of the yield curve. And so we think that 2025 will be a positive year for all asset classes.
All right, let's talk real estate here. Where do you see opportunities in real estate here? We've got the Fed cutting rates. I would think that's good for that asset class. Where are you guys seeing the most opportunities?
Yes, that's correct. So reducing the short end of the curve, the Fed funds rate, is beneficial indirectly for real estate because naturally it moderates the cost of capital. We're seeing opportunities in the industrial space, in the multifamily space, and really in the specialty space as well. And so these are all sectors that are seeing low vacancy rates. And so that helps to drive lease rates up because there is much more demand relative to the supply that's available. And if lease rates go up, the net operating income goes up. And NOI, for short, is a key driver of value. So what we've seen recently in the last 2 years is the capital values have come down significantly, but NOI has gone up significantly. So in other words, you can buy more real estate at a discount, and that real estate is generating more income. And so that will hopefully drive returns in the future.
How much of this is predicated on rates being cut from the Fed, and how much of it is just sort of the economic cycle?
I would say the majority is driven by the economic cycle. Okay. The change in interest rate environment really it inflated cap rates, which was the main driver why prices were down. But unlike the global financial crisis, which was the last big drawdown for real estate, there's very strong fundamentals that are driving real estate currently. Like I said, vacancy rates are low, and it's much harder to construct new developments, new property developments today versus 15 years ago because of inflation. Construction costs are up. The other factor, for example, specifically for the industrial space, is that we're all buying more products online, and we want them shipped to our houses faster. And so that causes demand for warehouses that are closer to city centers so they can get to our homes faster. But nobody wants warehouses in city centers or close to cities, and there's no vacant plots available for those warehouses. So there's that imbalance as well. We have examples across the board. Data centers, for example, another great example, because everybody is consuming more and more information constantly every year. So that drives significant demand for data centers.
I tell you, all those warehouses for servicing New York City and Philadelphia, they're right in my backyard and John Tucker's backyard in Central Jersey. Access to the New Jersey Turnpike, Garden State Parkway, all that kind of stuff. 287, you can serve both Philadelphia and New York.
Maybe that's why the UFOs were there.
Maybe.
Yeah.
Exactly.
Maybe we can make that link.
Maybe, exactly. hey, Miguel, let's say I want to go out and buy some commercial real estate. Is my bank going to lend me money? Where do I get the debt financing these days?
Yes, so typically commercial developers will go to specialty lenders, and depending on what type of property one is buying, if it's a fully developed and occupied building, it's stabilized, as they say, because the occupancy rate is high, then lenders are much more willing to provide capital for that and increase the loan to value on that property. But if it's a empty plot of land and it's a development project, then those are typically construction loans. And so there's a wide variety of sources for capital. Banks have typically been reluctant, especially recently, to provide capital for sectors that are struggling, from like the office space. But there's certainly a broad variety of sources of capital, starting from banks all the way to individual investors who are happy to provide some of those short-term construction loans.
Before we let you go, for, say, private credit, where are the opportunities there going into 2025?
Yes, private credit is one of our favorite sectors, specifically because, as I mentioned, the interest rate is in this Goldilocks phase where we aren't in 23 or 24 where we don't have that visibility or uncertainty of how long and how far interest rates will climb. And so interest rates are at a point where the peak is behind us, but they're not at zero either. And so that favors the lenders versus the borrowers. Now you can, especially in private credit and alternative private credit, you can receive 9%, 10% even interest rate on loans to corporations that are established, they're mature, they're cash flowing, and that are going to pay through that debt until maturity.
Miguel, thanks so much for joining us. Miguel Sosa, Head of Market Research and Strategy at Blue Rock, joining us here talking about the commercial real estate business. And, of course, a commercial real estate business, as is residential real estate, really dependent upon interest rates. Let's get a sense of where we might see interest rates move. We got a Fed meeting coming up on Dec 18. Katerina Sarajeva, Federal Reserve reporter for Bloomberg News, joining us from the bureau down there in Houston, Texas for Bloomberg News. So, Katerina, I guess the market's pricing in a 25 basis point cut next week. What do you expect to hear from the Fed on December 18th?
Yeah, I think it'll be an interesting meeting. I mean, we haven't had a super clear signal that they're going to cut rates by a quarter point, but that is what the market's expecting, and we've certainly heard Fed officials say that, that's likely. But I think after that, they'll probably signal that they want to slow things down. We've now had 3 consecutive rate cuts, including that big one in September. That was a 0.5 percentage point. And I think they're going to want to really slow things down next year. Economists are expecting just 3 rate cuts for the whole year. And I think that, that comes with kind of some uncertainty about what the economy might look like next year. And also, what you guys were talking about with Bill Dudley about where the neutral rate is. It may have moved up, so they'll kind of have to feel their way around that a bit.
Is it possible that the Fed can sort of keep their growth target firm and their inflation target where it is and not move the neutral rate higher?
Potentially. I think that is, yes, I think what you'll hear them say is that that's what they will do. I mean, they do not want to change the inflation target, especially before they achieve it, right? We're not there yet. We're not at 2% inflation yet. And the neutral rate, moving up, what that means is that they may just have to keep interest rates higher to be able to achieve that 2% inflation target. So I think that's kind of how you'll hear them talk about it. Like, maybe it just means higher rates than we had previously thought.
So, I guess the question is, some of the economic data, one could argue that they don't need to really do anything. They can sit on the sidelines. Do you think that's a message they might want to try to convey?
Perhaps. I think certainly on the labor market side, things are looking pretty decent. There's a few signs of a slowdown and a few things that aren't looking amazing, like kind of the longer term unemployment rate, some things like that. But big picture, it is looking like a strong, healthy labor market. On the inflation side, we've stalled out a little bit. So I think you might see some caution in how they talk about inflation, because that's still, it was coming down pretty well, but we've now seen that progress kind of slow down a bit. So they might start, we've already heard some of the more hawkish members of the Federal Reserve talk about how that's concerning to them. And it'll be interesting to see if we see some more dovish members talk about that as well.
Yeah, do you think we're going to see some bifurcation there? Like, it's not going to be all consensus, right?
Yeah, I think, in terms of the actual vote next week, we might be able to get a unanimous vote, especially if they have some language in there or just some hinting that, things are going to slow down a good amount next year. So it'll be kind of, some economists have been calling this a hawkish cut. They'll cut next week, but they'll kind of indicate that they're going to be a bit more hawkish next year. But I do think there is a bit of a bifurcation on the committee right now. You certainly have some people who are expressing real concern about inflation.
All right, Katerina, thanks a lot. Really appreciate it. Katerina Sareva, Bloomberg Federal Reserve reporter, joining us on what the Fed is going to do next week. All right, coming up next, it's vacation time. Not for me, not for Paul, but maybe in 2025. Apparently, 72% of vacationers are aiming to boost next year travel spending. This is according to a Bloomberg Intelligence survey. We're going to bring you the author behind that report with Jody Laurie, Bloomberg Intelligence credit analyst, joining us there. All right, taking a look at the markets here. You were looking at a rebound in the NASDAQ, up by 0.3%, really helped by Broadcom, $2 trillion market cap.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're being brought to you by New Jersey Institute of Technology, NJIT, designs for the future, making career paths in digital, industrial, and interior design tech-focused and tech-powered. Learn more at njit.edu/design. Well, the tech-heavy NASDAQ 100 on track for another record close. Its best-performing individual stock far and away right now, Broadcom. It's up over 21%. They're predicting a boom in demand for its artificial intelligence chip, reaching $1 trillion in market value. All good right now. That's also boosting some of its peers like Marvell Technology, Micron Technology, shares of NVIDIA. They are, they were up. Right now they have turned lower, down 1%. Jared Woodard, Bank of America Securities, says, you know what, the backdrop for stocks is very favorable.
We think there's a lot of potential from deregulation, from earnings running out across the economy, and for higher productivity, particularly in the United States, continuing a trend of higher productivity that started even some years ago.
Right now, the S&P 500, it just turned lower, down 2 points. The Dow Jones Industrial Average, 36 points lower, and the NASDAQ 100, that shaved some of the earlier gains, right now up 0.5%, up 116 points. As for the yields, two-year yield, 2 basis points higher. That's at 421. The 10-year right now, 4 basis points higher, and that is at 436. There seems to be something turning markets lower right now, or at least shaving some of the earlier gains. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
I know, because it's Friday the 13th.
Ooh,
so you're going to take off some risk into the close. No, I'm kidding. Although maybe, I don't know. But nonetheless, taking a look at Broadcom, which is pretty impressive, those earnings and the numbers coming out there. All right, traveling. If you're booking 2025, you're trying to see how much money you're going to spend. Apparently, you may spend more. So Bloomberg Intelligence has a great 2025 survey for U.S. vacationers. And what they found was pretty staggering. Jody Laurie is Bloomberg Intelligence credit analyst, and she joins us. Now, Jody, walk us through some of the findings of your survey.
So, Alex, I have to say, as a credit analyst, and I've mentioned this a few times on your show, we get uncomfortable with the amount of optimism. I was uncomfortable personally last week because we did our credit outlook event, and it was a bit too optimistic for my liking. That said, the data doesn't lie, and when we surveyed vacationers, 72% said that they're willing to spend more in 25 versus 24. Now you compare that to last year, where it was only 67% said they were planning to spend more in 24 over 23. So it's a pretty big bump.
Where are they spending it? How are they spending it?
Sure. So, Paul, I mean, I think if you think of the average person, going on vacation is a big thing. We zeroed in on people who are planning vacation as a priority for next year. And for those people, they are actually saying 79% are saying that they're spending more on travel over clothing. And that was compared to 70% last year. Now, where they're going is also interesting because we saw a big spike in vacationers who are planning on going on cruises, that's 37%, as well as on all-inclusive vacations. And we did see a pullback in theme parks. We saw a pullback in casinos and racetracks. Wow. And so what we're seeing is a lot of, I guess, set it and forget it type vacations where people can do these big, luxurious things, and also in hot places like the Caribbean, Italy, or Mexico.
Oh, that's interesting. And also then in terms of budget, like you said, set it and forget it. Like you get the budget and it's done. Like you know exactly how much you're going to pay. You don't have to think about it. That's quite interesting. What's taken a hit? Like you mentioned maybe where they're not spending money as much.
Right. So I think what we're a little bit concerned about, Alex, and we've been expressing this for quite a few months now, is in theme parks. You know, theme parks had a very good run in 2022. And the question is, are they going to see that same run in 2025? And so far the data is saying no. It's a little bit hard to say, but I would suspect that a lot of people are getting sticker shock for the destination theme parks. And then the regional theme parks, of course, you know, we had the big merger between Six Flags and Cedar Fair. We, of course, have United Parks, formerly SeaWorld. And I don't know if people are necessarily either counting that as a vacation because they're a one-day trip, or if they're choosing, instead of doing these one-day trips, to do these big lavish vacations, and that's where their budget is going.
That's interesting.
How about Europe? Because you hear stories about how Europe was just overrun by American tourists over the last several years, and I have to admit, September is my Europe. That's our new thing. So we're doing Europe in September. Last year we did Ireland. This year I think we're going to do Italy, confirming that tomorrow with Kelly with Hawaii. Talk to us about Europe. Are Americans still going to Europe? Because, I got the euro at almost parity.
Oh, yeah.
Paul, you are going to be one of many people going to Italy next year, it seems. We had a big bump from last year. So people who are going to Italy last year was only about 18%, and now it's 25% of our vacationers. So that's a pretty big spike. Now, putting it into context, Italy isn't quite back to where it was pre-pandemic in terms of vacationers or travelers into Italy, but they are getting there. What we are seeing is, Mexico, the Caribbean, it's very, very high, and it's going to get higher. Places like Italy, Portugal, Spain, those are going to do very well next year too. Whether or not we get back to pre-pandemic levels for some of those countries remains to be seen, but you might see that you're a little bit crowded, Paul, and perhaps the government of those countries, they've been talking about limiting cruise lines, for example, in terms of docking. And so,
interesting.
It might be a little bit harder to get there. You might have to be a little bit more creative.
I'm going in September.
Yeah, he's going in September. He doesn't have kids in
you'll
school.
be fine.
Like, he's good
September,
to go.
you'll be fine.
I'm the one with the problem.
Yes.
I'm planning a Scotland trip in July. That's going to be something. So let's talk about individual companies. So you're a credit analyst. Which kind of companies are going to win from this?
We're suspecting that Royal Caribbean and Carnival in particular are going to do quite well from this. You could also say a Viking would do well because the smaller vessel cruise ships are going to be able to access these small islands in the Mediterranean. But companies that also could potentially do well, we think, is something like a Marriott or a Hyatt in terms of, publicly traded companies, I should say. And the reason being is, Hyatt, for example, they bought Apple Leisure in 2021, and that gave them a bigger footprint into Mexico, into the Caribbean. These companies have been focusing a lot of their dollars on the Caribbean. But also something interesting is Marriott actually yesterday announced an acquisition of a company that focuses on wilderness and sort of these natural cabin type places that are domestic. And we're seeing domestic
Cabin, like what?
Is increasing. Yeah, cabin type places. So really getting a big kind of mix of things. Competition with, I guess you could say, the Airbnb or the outpost Airbnbs. And we are seeing that a lot of people are preferring domestic vacations next year. It's spiking to 98% are planning on going on domestic vacation versus 96, I believe it was last year. And international is staying flat at about 78%. So people are looking domestic. We might see more national park spending or national park visits than we saw, and Marriott's taking advantage of that.
Jody, thanks so much for joining us. Good work here. Jody Laurie, Senior Credit Analyst, Bloomberg Intelligence, talking about some of the leisure businesses. Here's a recommendation for you. National Park, Yosemite National Park, in the Valley, tent cabins.
Oh, there is no way
John,
I'm doing that.
You know me. To me, Four Seasons is roughing it. But we did the tent cabin with the kids, and it was awesome. Real beds, stuff like that, showers, communal showers, but real showers. But
you're in communal showers. But even Alex is like, no way.
Well, it's not like you have your own little stalls and stuff, so you have the privacy. But you're on the Yosemite Valley floor. Awesome.
No, I did stay in Yosemite at the National Park Hotel there, which was awesome too. Spectacular.
Fantastic. And the one at Yosemite Yosemite is awesome. Same thing is awesome as well. The national parks were overwhelmed the last few years.
Yeah.
They're all at capacity. If you haven't booked it now, I don't think you can because, people have been going crazy and they're going back to the national parks, which are awesome. But again,
I'm not going to go there.
Yeah,
but,
Johnny doesn't do tents anymore.
No, I never did tents. I have a bad back. It's hard.
You're a New York City guy.
There's like an 85-year-old woman inside me.
Exactly.
Anywho,
all right,
those are vacation plans. All right, coming up, Vernon Silver will be joining us, Bloomberg investigative reporter. It is the big take story. Human eggs are now a premium commodity for the global market. We will break this down. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well, so check us out on Bloomberg. Head over there and check out Bloomberg Big Take, or the Bloomberg podcast, and that's where you'll find us there. Speaking about the Big Take, we love the Big Take stories that come out of Bloomberg News, and they're often featured in Bloomberg Business Week magazine, as this one is talking about the story of eggs, and not the eggs we typically talk about. We're talking about human eggs and the extraction and the valuation and the exploitation of eggs around the world. It is a global business. I was not really aware of this until I read this story, but again, the Bloomberg News folks have a phenomenal story out here with lots of deeply reported reporting, deep sourcing, some great graphics that really kind of bring it all to life. Vernon Silver joins us, senior investigative reporter for Bloomberg News from Rome, Italy, via Zoom. Vernon, talk to us about this story. Just walk us through this story and how it came about.
Yeah, I think what's interesting is when we think about global commodity markets, we don't necessarily think about something like human eggs, but as demand for fertility services has grown in the past decade, it's now an industry globally worth $34 billion or $35 billion per year and growing. They need a raw material, literally, to make the babies, and the raw material in this case is the human egg. So in a way where we might see materials that you need for car batteries, for electronic cars, or for other types of products that are made, there's demand for the egg. And what we found in reporting on 5 continents is that the prices are going up, and the extent to which the industry will go to get these eggs is raising the stakes, where there are some people who might be exploited, in some cases even having their eggs stolen from them.
Right. I was going to say how one gets them. So can you walk us through the different methods that you found in your reporting of how these eggs are harvested?
There's an entire spectrum of how it's done, from the model in Argentina, who we followed in her journey, who is getting tens of thousands for her egg donations. And we follow those eggs all the way to a family that she helped create in Australia, 2 kids made from her eggs, through sort of middle range, where there were Taiwanese so-called egg girls who are coming to the U.S. to sell their eggs for a little less money, partly for the Chinese market, people who come to the U.S. from China, where this sort of thing isn't allowed, to the more difficult cases. A case in India, one of many, where a girl, a teenage girl, was paid for her eggs by a system that cultivated her. She was able to get, maybe $100 out of it to buy a smartphone. Minors aren't supposed to be donating their eggs. To this case in Greece, where we found in one clinic alone on the island of Crete that the police had found as many as 75 different women who had gotten their eggs allegedly stolen while they were undergoing IVF at that clinic.
Vernon, is this egg trade, I can't think of another word for it, is it legal?
It depends where you are, and this is sort of part of what makes this trade go around. I mean, picture other sorts of trades, the drug trade or the banana trade. Anything that you're selling around the world is regulated in different ways. And in this particular case, where I am in Italy, the rules are very strict. So Italians who are trying to get these services are going to places like Greece to do that. During COVID, people stopped moving so much. So the actual shipment of the eggs, rather than the movement of the people to get them, increased. And there's new technology over the past 10 years of freezing these eggs that allows them to be preserved very reliably and then shipped in metal containers pretty much anywhere around the globe.
Is it safe for the women?
There are risks, and one of the issues is that those risks are unknown. One of the most common problems in egg donation is hyperstimulation of the ovaries. Normally, a woman will produce 1 egg per cycle. In this case, they're stimulating the ovaries to make, in some cases, 20, 30 eggs. That can make the ovaries swell, can cause complications. There have been deaths as a result of this, and that's part of what we uncovered in this investigation.
Vernon, where do these eggs tend to wind up?
like a lot of other precious commodities, they go from the poorer parts of the world to the richer parts of the world. And the issue on the supply side is pretty clear, that these women may or may not be exploited for their eggs. But on the demand side, there's a question now of whether the families, in the developed world, in particular, who are buying these imported eggs, know where they came from. Can they reliably say that the eggs they got weren't stolen or weren't from, a minor girl?
How does egg theft work? We have like 45 seconds.
A woman goes into a clinic to get her eggs done. They take a dozen of them, tell her, hey, we found 6. She'll never know the difference that those other 6 have now been set aside and fertilized with the sperm of a different client without her knowledge, ever.
Wow. Anyway, it's a great piece, guys. And he profiles like a bunch of different women that have participated in this pretty much across the globe in different age ranges. So definitely check that out this weekend. Bloomberg.com/bigtake, or you can check it out on the terminal. Vernon Silver, Bloomberg investigative reporter, on the story that human eggs are a premium commodity for a global market. All right, speaking of taking a look at the overall market, you got equities turning lower now. NASDAQ off by 0.2%. We are headed into the European close in about half an hour, and those stocks are also trading a little bit heavy. Plus, volume is pretty light as well. Taking a look at the bond market, you're seeing yields higher. You're having the 10-year yield above cash rates for the first time since 2022. So you have that bear steepener taking hold there within the U.S. And taking a look at the currency market, it's a mixed dollar story. It depends what G10 currency you're looking at, but it's been a pretty good week for the dollar. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformer